underpinnings of this market are still in decent condition.
The big story is earnings.
The reality is the earnings prospect remains very positive.
Right now, you're seeing so much earnings growth within these semiconductor names that it's a question of how sustainable they will be.
You're probably going to see companies continue to be cautious about the outlooks for Q3 and the rest of the year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, tension building, crude elevated, the US striking Iran for a fifth straight day. Higher energy prices failing to stop United from raising its outlook after Wall Street wraps up a record-breaking quarterly earnings season. Up next, the CEOs behind the numbers, Scott Kirby, Brian Moynihan joining the program later this morning.
So far, earnings are triumphing over macro concerns, even with the pressure being put on a lot of these companies from high oil prices, from uncertainty. The rhetoric has been that the consumer is strong, demand is resilient. A lot of it is being driven by the higher end, the upper end of the K, and there is a sense that it can continue over the near and medium term.
You've got to take note of how this market's responding to some of these numbers, though, particularly on the tech side of things. ASML out of Europe, fantastic numbers. TSMC, Taiwan Semi, fantastic numbers. Nasdaq is down on the week. Tech trade is still struggling a little bit, even with that as your backdrop right now.
It's struggling to understand what it is. For a while, it was moving away from hyperscalers, going to the semiconductors. And now people have decided, regardless of what the earnings say, we're going to shift back to the hyperscalers. So that's what you've seen, because people are skeptical about how long this can continue, given the fact that there's a renewed focus on expense, on cutting expense, on doing it yourself, on competition. And that fear is triumphing over, frankly, earnings that keep beating, but they aren't beating necessarily by $10 billion in each unit, the way that maybe you saw in other places. And that's the reason why maybe you've got a little bit of skepticism. But otherwise, it just simply is that people have shifted their focus and the market can only focus on one thing at a time.
To your point, those profits have insulated this market from this mess in the Middle East. Check out crude this morning. Still elevated, but slightly lower. We're down on the session by 0.2%. WTI around 80. Brent crude still around 85. Striking Iran for 5 consecutive days, wave after wave after wave.
Yeah, and last night's wave ended around 9 p.m. Eastern time. Again, CENTCOM coming out saying they want to degrade Iran's capability for going after commercial vessels in the Strait of Hormuz. Also, this got my attention last night from the Wall Street Journal. Trump leaning towards expanding military operations in Iran after days of briefing with top aides. We have been here before, but the President of the United States, along with his team, another Situation Room meeting, potentially looking at options that they can go in and do a little bit more of escalation to try to get Iran back to the negotiating table.
This is why the coast isn't clear. This is why for Kevin Warsh, the Fed chair, it is not mission accomplished. Look at the data we had recently. Gasoline prices, biggest decline in gasoline prices since 2022. How much comfort can you have with those numbers when things are looking increasingly uncomfortable in the energy sector?
Well, Fed Chair Kevin Warsh said that he's not comfortable, and the market is saying we're getting a lot more comfortable, because what you've seen over the previous 2 trading sessions was the biggest 2-day drop in 2-year yields going back to early April. People are saying, okay, this removes the urgency for a rate hike. And increasingly, people, when you talk to them, expect the Fed to be on hold for this year and then cut rates next year, even though in the market they're pricing something different. So even though Kevin Warsh is coming out and saying the coast isn't clear, he's leaving little tea leaves that give people hope that maybe he still is on the more dovish side, including some of his comments on AI.
CPI a little bit softer, PPI a little bit softer. The next data point, 8:30 Eastern time. Jobless claims just around the corner. I'll take a guess, 215, 220. That's what it usually is.
Bold.
Around 8:30 Eastern time. Yields this morning, 4.15 on 2s, 10s around 4.60. 3 hours away from the cash open this morning, with equity futures slightly elevated on the S&P 500 this morning. We see futures down by about 0.1%. Coming up this hour, we'll catch up with Brian Levitt of Invesco on the high bar for earnings. We'll speak to Norman Roule of CSIS as the US strikes Iran for a 5th day, and Mark Newman of Bernstein as TSMC posts a 77% profit gain. We begin this hour with stocks sliding following 2 days of gains. Brian Levitt of Invesco forecasting more robust earnings on the horizon. Writing the bar is high for the tech sector. The focus is likely to be on guidance. Misses are likely to be hit harder than usual. Brian joins us now for more. Brian, good morning.
Good morning.
It's good to see you, buddy. The earnings have been great. The reaction has been somewhat mixed. What's your read on that this morning?
A little bit of the, my point about the bar being high. I think we came into this year, everybody was so worried about if the demand was going to be there, and we know the demand is there, and the markets had to catch up to it. I think the markets have come along to the fact that, this is a strong demand story. But at some point, the earnings growth starts to moderate. It's nothing disastrous, but it does start to moderate. So I think you're seeing a little bit of unwind in sentiment, a little bit of unwind in leverage in these markets, but fundamentals continue to look quite good.
Are there pockets of the market that you are uncomfortable with? And I ask that because typically you're quite bullish and constructive on the market.
I'm not overly uncomfortable with it. There's pockets of the market that I've been getting more excited about, and we've been talking about for a while. I mean, we sat here in 2024 talking about only 7 stocks winning. At that time, we would have been thrilled to have seen the other 493 performing as well as they have within the S&P 500. And so what you're seeing in financials and other parts of the market is all very comforting. That's not the sign of an economy that's rolling over. It's not the sign of a market that's rolling over. It's in essence a sign of expectations getting incredibly high in the tech sector, but market activity broadening to other parts.
How do you understand this shift to hyperscalers away from semiconductors? Is it just an exercise in valuation, or is there something fundamental behind it?
I don't think it's a huge fundamental issue. I think that you had seen such a big move in the chip stocks and such a big move in the memory stocks that you were likely to see some unwind in momentum. And, you look at the chip sector, which was up, like 75%, more than that year to date, and it's been off a bit since, not a bit, 17% since June 22nd. So, that's a bit of a momentum unwind. I don't think it's a harbinger of anything disastrous. Again, the fundamentals are still quite strong.
Do you think the chip sector has outsourced its trading activity to Korea? And what's going on with some of the single name volatility and the greatest volatility that you've seen since the financial crisis? No, I mean, I wonder how much what happens in that market in the Kospi is filtering into the United States and really causing a lot of people to feel anxiety.
I think there's a whole, I don't think that it's necessarily because it's happening in Korea. I think it's all part of the same trade where this had just moved so far, so fast that investors are reassessing their expectations, reassessing just how fast this can grow. Again, fundamentals are very strong, right? This is the type of growth that we don't typically see, right? And so the tech sector is going to continue to post strong earnings. Sentiment has just gotten very high, and it's a bit of an unwind. I don't think it's anything particularly ominous.
I've got to be honest, Brian, from my perspective, it's easier to identify a pool of doubt right now relative to a deep pool of exuberance. If I look at the bank earnings from earlier on this week, the conversation we had repeatedly is whether they can repeat the act. Is this as good as it gets?
Right.
Is that skepticism a wall of worry we can keep climbing?
Yes, I believe it is, and I continue to think that the backdrop continues to be favorable. I mean, the backdrop coming into the year was about as good as I could have remembered. We disrupted it with the war in Iran. It looked like we were moving past it. We saw inflation expectations down, oil prices down, gasoline down. All of this was moving favorably. We've got a little bit of a hiccup there. I don't think it's a huge surprise to see, tech sell off a bit, or, mid to late June with Fed officials getting a little bit more hawkish, and now maybe we're backing away from that. Of course, the conflict still continues. Ultimately, I think we move through it. Macro backdrop remains strong. I am one of those people who believes the Fed is on hold. I do believe we will ultimately get cuts in 2027, and I think we'll see the conflict have some type of resolution or some type of extended ceasefire that keeps commodity prices lower and the global economy picking back up again.
At the moment, though, we don't. We're back to hostilities. And the president is even considering potentially even sending ground troops when it comes to maybe seizing Karg Island. How does the market look through that? Yeah,
so we've heard this before, and I think the market is generally expecting some type of reasonable resolution on this, or something that allows the market to keep it in the background. And that's basically where we've been since April. So we have not had any type of concrete resolution, but the market's been willing to look past it. That's where the market still is, even with oil creeping up in recent days. If not, different story. But ultimately...
What if this goes to a level that it becomes much more volatile than we are now. How does the market can't look through that, can it?
Well, you'd have to get a sense on what it means for economic growth and what it means for Fed policy. And so if you were to have a sustained rise in oil prices, gasoline prices, I'm not talking about a couple a day jump where the oil prices go up 20% and then start to come back down. I'm talking a sustained move higher, and that starts to really weigh on U.S. economic activity. That's a different story. Ultimately, what I think we're dealing with right now are commodity prices, oil prices that are going to be volatile based on the news flow. But my expectation would not be a sustained, $110, $120 a barrel.
You might have some insight that none of us have. What does it mean for Fed policy? Because at this point, after 2 days of testimony, I don't know. Do you?
Yeah, they're all over the place. I'm of the mind that what we've been hearing is a bit more dovish. I think I've said many times.
What gives you that steer?
Well, I've been watching the inflation expectations, which are very well contained. The job market is not overly robust. Wage growth is modest. Goods prices are fine. Shelter costs are moderating. So I don't know why we would be raising interest rates into this. I don't want to raise rates because of a supply shock in the commodities market. And I think that's where the Fed will be as well. If not, different story. I'm going to call them. They don't answer my calls, but I would not be raising interest rates in this type of an environment.
Still a FOMO guy?
I am still very much a FOMO guy.
I didn't expect it to change today. Brian Levitt, thank you, sir. Brian Levitt there of Invesco. Equity futures slightly lower this morning on the S&P 500. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, good morning, John. U.S. striking Iran for a fifth straight day, hitting a sanctioned oil tanker near the country's main export terminal. Iran responding by firing upon American bases in the region. The Wall Street Journal reporting President Donald Trump discussed seizing Carg Island in a meeting yesterday. U.S. Trade Representative Jameson Greer signaling modest expectations for a summit between President Trump and his Chinese counterpart, Xi Jinping.
The number one deliverable we always have between President Trump and President Xi is to continue the stability of the relationship. Both of these leaders are very committed to having a strong and solid personal relationship. We will have an opportunity to take stock of Chinese commitments with respect to purchases of soybeans and other agricultural products. We'll take stock on the rare earth issues we decided.
Trump expected to meet with Xi in the U.S. in September. And in sports, the World Cup final is set. Argentina will play Spain on Sunday after defeating England 2-1, coming from behind and scoring both goals after the 85th minute of play. President Donald Trump is planning to attend the game in New Jersey. And that is your Bloomberg brief, John.
On behalf of my friends across the nation of England this morning, we'll pretend that didn't happen. Up next on the programme, escalation with Iran.
They want to settle so badly. They don't like what we're doing. And they do want to settle. We'll find out whether or not we settle with them or we just finish it off. The country is booming, and we'll have Iran defeated soon.
Norman Roule of CSIS joins us next, live from New York City this morning. Good morning. Coming up on the programme, 8:15 Eastern Time. Don't miss this. We'll catch up with Scott Kirby of United Airlines after that company raising its guidance after facing down some serious fuel cost problems. Then we'll touch base with Brian Moynihan in the studio here in New York City, 8:30 Eastern Time. Looking forward to catching up with Brian after what looks like the best start to the year this company has ever had. What a quarter, what a first 6 months for the big banks on Wall Street. Equity futures this morning on the S&P 500, slightly softer. On the S&P, we're down by 1/10%. On the Nasdaq, we're down by 0.5. Down 0.5, even with great numbers out of ASML, fantastic numbers out of Taiwan Semi, and this tech trade is still stumbling.
It's changing. It's really still a punish semiconductors after a meteoric rise. Maybe go into hyperscalers, because even amid yesterday what we saw, which was ongoing softness in the semis trade, you did see an outperformance of the likes of Amazon and Microsoft and Google or Alphabet. And so this is the question. Do you see that rotation continue, or is this an overall read on overexuberance in the tech trade?
That's the story in the stock market right now. Here's the story in the bond market. Yields lower off the back of softer CPI, PPI this morning, just a bit higher by 2 basis points. Still around 420 at 415.77 at the front end of the yield curve. The move in crude looks like this, still elevated, but declining by 0.1%, around 80 on WTI. Brent crude around 85. Under surveillance this morning, escalation with Iran.
They want to settle so badly. They don't like what we're doing, and they do want to settle. We'll find out whether or not we settle with them or we just finish it off. The country is booming, and we'll have Iran defeated soon. A lot of people thought oil would go up to $350 a barrel. It went up a little bit because I had to take tough action. When that settles down, I think you're going to have $55 oil.
So here's the latest this morning. The US striking Iran for a 5th consecutive day and hitting a sanctioned oil tanker sailing towards Karg Island as Tehran shows no signs of backing down. Bloomberg's Tyler Kendall has the latest. Hey, Tyler.
Hey, John, good morning. Well, it is another day where Iran is reiterating that the Strait of Hormuz will remain closed until further notice as the U.S. steps up its own action. The Pentagon confirmed that it hit this supertanker near Karg Island as it moved toward an Iranian port, marking the first such attack on a vessel since the U.S. reinstated its naval blockade. Now, we heard from CENTCOM last night saying that it helped at least 10 ships transit through the strait overnight as the 7-day average for oil flows in the waterway has fallen from 4.6 million to 3.9 million barrels a day, according to RBC Capital Markets. And it is numbers like that that's leading this White House, according to our reporting, to consider extending that Jones Act shipping waiver in a bid to make sure that it stays easier to move oil in this country amid what feels like we're headed towards prolonged supply disruptions, because we're seeing this reporting from the Wall Street Journal that is indicating that President Trump is leaning toward expanding military action, which could mean the potential for ground troops, though the reporting goes on to caution that he hasn't made a decision quite yet. And, John, we heard from the Vice President, J.D. Vance, last night in an interview, seeming to bat down part of that notion, saying that the U.S. isn't looking to put boots on the ground. And President Trump himself has opened the door to diplomacy, reiterating yesterday his claim that Iran is coming to the U.S. asking for talks, though, of course, we haven't heard public confirmation from the Iranian side that they are looking to do so.
Tyler, how closed is the diplomatic channel right now? Are there any talks going on between Steve Witkoff and Jared Kushner and their counterparts?
Well, Annmarie, as you know, President Trump has indicated that he would be okay if his negotiators kept talking. He did list Steve Witkoff and Jared Kushner last week when it comes to his top negotiators. But at this point, we haven't gotten indications that those talks are continuing. In fact, we're seeing that the U.S. is instead trying to pursue this more kinetic action, but then also that economic pressure with the naval blockade and revoking that oil waiver that had allowed Iran to sell its crude to market. President Trump did say yesterday that there was this goodwill gesture and noted that Iran had released an American that was imprisoned in the country, though we didn't get many details beyond that. And that was taken as a potential sign that, of course, these talks are still happening in the background towards trying to get them back to the negotiating table. But at this point, we really haven't gotten that confirmation that they're making stronger progress or even on that technical level about what they had agreed to talk about when it comes to curbs on Iran's nuclear program.
Tyler, stay close. Let's just pick up on that reporting. Annmarie, I want your feedback on that. The possibility, the potential that this could spread from limited action to a bigger, let's use the president's word, excursion, that this could be a return to revisiting the kind of things that we were talking about in March, April time, which is seizing Karg Island. What kind of military capabilities, resources do we need to achieve that? Because at this point, it still seems unclear to me that we have the ability, certainly have the willingness, to maintain an open passage through the Strait of Hormuz. Given the asymmetric nature of this, the fact that Iran can make that very difficult for both shippers and the US alike with very cheap drones, have we done enough sufficiently to establish, provide any evidence whatsoever that that's achievable?
Well, I think for it to be more achievable, you would need more troops in the region, amphibious assault ships, and also if you're thinking about trying to take control of an island, you would need ground troops. Absolutely. So I guess that's at this moment, that is what the president is weighing. He has given Iran a very long leash to try to come to the negotiating table. And at some point, the president might want to escalate because he's left with no other option.
Here's the take from Roule of CSIS. He says this is no longer a ceasefire suffering violations. It is a limited enforcement war with no apparent diplomatic exit. Norm joins us now from Norm for more. Norm, always appreciate your time, sir. So please elaborate and tell us what kind of phase you think we're in right now and what is the potential for this to become something bigger, something less limited?
Good morning. So we're looking at the Iranians using attacks as part of their negotiating strategy. These attacks are not saturation strikes. They're limited, but they're sufficient to demonstrate that Iran has the capability to close or to restrict traffic in the Gulf, the Strait, and in the Arabian Sea. At the same time, the United States is undertaking a series of expanding and widespread attacks that are both degrading Iran's capability to attack shipping and to demonstrate to the Iranians that there is a material price to be paid for their lack of diplomatic engagement. Now, the diplomatic channel remains narrow, but it is open, and through the release of the American citizen, that is evidence of that. But as a ceasefire, this construct no longer is working. So what the United States is hoping, apparently, is that its actions will provoke a debate in Iran amongst its leadership. Basically, do they want to take this a lot farther? I think the answer is going to be yes in the near term, but events will dictate the course of this dynamic.
Norm, can you provide some more context on the debate happening right now within the elites of Iran? Because some individuals are calling the likes of Mohammad Ghalibaf a traitor for even having these negotiations with the United States.
Well, you want to be careful about anyone outside of that dynamic, especially 6,000 miles away, talking with great clarity. But it is clear that we have, especially in the wake of the funeral of the previous supreme leader, a space where individuals in this political world are each trying to outdo each other for a tough position on the United States and the region. Now, that is likely going to remain constant for some time. But again, in the long term, or in the medium term, rather, Iran has got to decide, do they want the United States to continue to move attacks north, to cut down maybe some of the bridges, to restrict the flow of trade into country, which touches their inflation, unemployment? It is a conversation that its leaders are going to have to undertake. I think in the short term, the dynamic is going to be for Iran to continue its pressure against the West and its neighbors.
Norm, how much can President Trump escalate without Congress signing off on some sort of resolution of war?
I think the administration would feel that it has considerable flexibility with the personnel that are in the region, as long as the United States is not engaged in a long-term boots-on-the-ground endeavor. The personnel that we have in the region are sufficient to conduct clearing operations that would take some time. But this is not a boots-on-the-ground forever war such as Iraq or Afghanistan.
Well, but that's sort of the issue and the tension here. How much are boots on the ground required to really escalate to the degree that really cripples the current Iranian regime, as AMH was talking about earlier?
Well, the comments that were made earlier are appropriate. I would say that this is no longer the 1980s. We have drones. The Navy has demonstrated some unique and special drone capacity involving sea drones. We don't need to have personnel on the ground as long as we have a capability to strip the Iranians of their offensive punch. Now, we do have personnel out there that are capable of raiding operations, and that's different from occupation. And even when you think occupation, it's a very long coast. So, putting personnel on 100 miles of coast is not going to be reasonable. So you want to really have your personnel go where the offensive punch is. And I'll close by saying we also need to keep in mind that drones and missiles can be fired from a long way from the region. So having personnel 10 miles in or 20 miles in doesn't necessarily stop the Iranians from conducting strikes. So this is a recipe that's going to require some complex work, but our CENTCOM leadership are really quite capable and experienced in this regard.
Has Norman Roule got a bug in our control room?
I love it.
How does he know what time is it?
Yeah, he's perfect.
Does he know what time the break is?
Well, and he also is like, and let me tell you. I love it. Norm, always great.
Because he watches every day.
Perfect timing, Norm. Thank you. Norman Roule there, CSIS. Why can't all guests be like that? Just take it up to the break and say, I'll close.
He's an absolute professional.
Without a doubt. Up next on the programme, Mark Newman of Bernstein as TSMC's 77% profit surge fails to impress investors. That conversation just around the corner. 2 days of gains on the S&P 500 this morning, pulling back by a tenth. On the Nasdaq, down by 0.55. We'll talk about the tech results in just a moment. You've seen the price targets, upgrades across the street over the last month from Wells Fargo, Barclays, JPMorgan, SocGen, RBC. I lost count a long time ago. Some pushback from Bank of America in their fund manager survey published in the last 24 hours. The equity overweight in the US, the biggest since 2024. Forecasts for a boom, the highest since 2022. Their take, reduce equity exposure. Summer upside for risk assets will remain stymied by bull positioning. That's what we're fighting this morning. Some very long positioning. In the bond market, 2s, 10s and 30s, yields still elevated, 2s still around 420. Yields higher this morning by 2 basis points of 415.56. 2 days of testimony from the Fed Chair, Kevin Warsh. What did you learn? That much, okay. Not much at all. And maybe that was the goal of the Fed Chair.
You know, we weren't expecting much, let's be very honest. At the same time, on the margins, there actually was something kind of interesting yesterday, and that was the rhetoric of Kevin Warsh around AI and the fact that maybe it isn't as inflationary as people expected, and that actually is in contrast to what we're hearing from other Fed officials that are saying this is their priority, that they're mostly concerned about inflation tied to artificial intelligence. It's pretty minor, but that's what I got from yesterday's testimony.
We'll be playing that clip out in about an hour from now. We'll have that conversation, so look out for that. Let's turn to crude. Crude right now, Brent and WTI, just about unchanged on WTI around 80, on Brent crude around 85. We just touched base with Tyler Kendall down in Washington, D.C. And as Tyler indicated, this reporting coming out of the Wall Street Journal, that the president is leaning towards expanding the military operations in Iran. That would catch this market somewhat off guard, even with the strikes we've seen over the last 5 days.
Right. It would be a serious escalation when it comes to what's going on in the hostilities. And as you say, off of a series of waves last night, 9 p.m., the latest series of waves from U.S. forces striking against Iranian facilities, military assets, defense sites, drone capability sites, everything that the Iranians, the IRGC, is using to attack commercial vessels the United States is going after. What Trump is weighing would be something a lot more in terms of an escalation.
Crude this morning, it's all calm. For now, at least. 85 on Brent, WTI around 80. 3 hours away from that opening bound. Let's get you some morning movers, some single names. Yahara has more. Hey, Yahara.
Hi, John. We are seeing TSMC ADRs falling nearly 4% in the pre-market, even after the chipmaker delivered a blockbuster quarter. It beat on earnings, raised its outlook, and also hiked its spending plans due to stronger demand. Yet the market is not impressed, and it may be that bigger CapEx number that is that is giving investors pause, adding to the angst that we've been seeing across the market about how the industry is spending so much on AI infrastructure and whether it will ultimately pay off. Turning to United, those shares are falling nearly 2.5% now in the pre-market, even after the airline posted a beat and raised the lower end of its full-year outlook. But its third quarter guidance did come in a touch lighter than expected. That was due to higher fuel costs. And it's the same story we've been seeing across the industry, with premium and international travel doing very well, but not well enough to ease some of the pressure after higher fuel bills. And we end on United Health. It just posted earnings moments ago. Shares are surging 8% in the pre-market. It delivered a beat and raised its full-year outlook again. And a big reason why is it paid out less in medical costs than Wall Street had expected, giving investors confidence in its turnaround plan. And what's notable is the stock had already run up nearly 30% year to date. So the bar was high and it more than cleared it. John?
Yahara, thank you. Thank you very much. That stock is up by 8%. More from Yahara in the next hour. On our radar this morning, TSMC ramping up its CapEx plans, expecting to spend up to $64 billion this year. The chipmaker affirming it's likely to spend even more over the years ahead after posting a 77% rise in quarterly income. Elsewhere, the JPMorgan boss, Jamie Dimon, warning of the risks around Anthropic's Mythos model.
That's a real issue, which I know our government is on top of at this point. It's really just to make sure we roll out the stuff that we know is being controlled, because you're giving ballistic missiles to individuals with Mythos, basically.
JPMorgan among a select few firms given early access to that model. Speaking of Anthropic, lining up talks with investors ahead of its potential mega IPO, reportedly working with banks including Morgan Stanley, Goldman and JPMorgan, the $965 billion company considering a public offering, perhaps as soon as October.
Yeah, and getting a credit line as they do so. There are a number of really interesting aspects of this. So number one is some of the skepticism that's been mounting about who is going to pay for all these tokens as the era of token maxing seems to be fading and token optimization seems to be surging. On the flip side, there's also a question of how much tolerance there'll be in not only equity markets, but also bond markets to possibly finance this, because they will probably follow the playbook that we saw from SpaceX, which is issue shares, do an IPO, and then issue a whole lot of debt. And I'm looking at the SpaceX debt right now, and it has just been tumbling. I mean, it was issued close to par, and now it's down almost 10 cents on the dollar. I mean, this is a pretty big decline, particularly the longer duration ones. So how much are they getting their sort of aspirations clipped by the market realities on the ground?
There's some pushback in the debt market. Not just on SpaceX, but Amazon as well. When Amazon came to market, we saw that in the secondary market. We saw some pushback, not just to Amazon debt, but to debt across some of these big issuers around this one theme. It raises the question really for the banks. The banks have been able to leverage this story really, really well. They get a piece of the IPO. They get a piece of the debt offering. We've gone through some of the numbers regarding equity trading revenue. That's been fantastic because the market backdrop has been so good. I can share some of the stats with you from Goldman. New Wall Street record for equity trading revenue. JPMorgan, Wells Fargo, Morgan Stanley, best quarterly profit ever. Bank of America will catch up with them later this morning. Brian Moynihan about 2 hours away. The best 6-month start to the year we've ever seen at that bank. For this to continue, you want the Anthropic IPO. You want them to do what SpaceX did. You want OpenAI to follow up after that as well. There's some question marks around that happening in that specific order in a timely fashion.
And so far, it seems like people are still willing to go to market even at a more expensive price. It hasn't been to the point where there is this sort of price sensitivity. That said, it does raise questions about the optimal time to not only IPO but raise debt. And so to your point, at what point is the pain threshold too high? Right now, it seems like the market, and you can see this in IG AI-related debt, you could see it softening, spreads widening, people starting to say, maybe this isn't as creditworthy given the glut of what's coming to market. If that continues, does it really lower people's ambitions? Unclear at this point.
The October date is interesting to me because, of course, the DoD is giving contractors and all the departments within the Pentagon to purge Anthropic by September 29th. That's what Breaking Defense has come out with. So basically, they're going to be persona non grata within the DoD right now, and then go to market for the IPO just weeks after that happens. All of this as they continuously have really difficult conversations with this administration that put export controls on them just a few weeks ago.
Any sign it's hurting their valuation right now? I've got to say, just looking at their valuation, no real signs it's hurting their valuation.
No, if anything, it only makes them more relevant. I mean, at a certain point, everyone's saying, look, I'm a risk too. Please pay attention to me because ultimately I could hurt you, but also I could help you.
It drives me insane. Is it a marketing pitch or the real deal? I don't think Jamie Dimon's along for the ride for the marketing pitch, so clearly he thinks some of this stuff is the real deal.
My sense is, in many conversations, this wasn't the government necessarily going to the banks and going to the well, not just the Anthropics of the world, but the more broadly, the LLMs and Anthropic specifically on Mythos. It was the banks going to the government and saying, hold on a second. This is actually a serious concern for us because of some of the vulnerabilities that it's finding, and potentially could threaten the monetary system.
The policymakers felt the same way.
Yeah.
Not just in America, but over in the UK as well and elsewhere. Got a real sense of that, the IMF meetings in Washington a few months ago, back in April. When this all started to roll out, there was more concern over that, more chat about that than there was almost anything else.
What happens if someone figures out how to absolutely stymie the payment system across the world? What happens if, say, some hacker from Iran or some hacker from Russia figures out how to use Mythos or Fable to get in and disrupt some sort of vulnerability in systems that have been built on top of each other that are naturally subject to human foibles? This has been something dominating a lot of conversations.
Get back to pen and paper, people. Get back to that.
That I don't think is happening.
Save the people,
Yeah, but
the
people are
market.
messy.
Ask for a raise, all right? Equity futures on the S&P, have to sneak that in. We're down by about 0.1%. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. South Korea halting new listings of single-stock leveraged exchange-traded products. The move follows a surge in popularity of funds tied to Samsung and SK Hynix. More than a dozen leveraged ETFs launched 2 months ago, aiming to deliver twice the daily return of the individual stocks, for example. King Street Capital is significantly restricting withdrawals from its flagship hedge fund. Exiting investors will be moved to a separate vehicle that will sell off the assets over time. The 31-year-old fund has struggled with lackluster performance, fleeing clients and an exodus of staff. The executive director of the International Energy Agency warning that the global economy will face a renewed challenge if the conflict in the Iran war resolved soon. Fatty B-roll saying the Strait of Hormuz needs to be fully and unconditionally opened in a matter of weeks, not months. And that is your Bloomberg Brief. John.
Not sure how much control he has over the situation right now, Vonnie. Thank you. And complacency will build because this market has been burnt once. Right? This market paid all this attention to this issue, then inventories insulated us from any of the consequences, the real fallout, the blowback from these attacks in the Middle East and the closure of the Strait of Hormuz. And now the second time around, people are just like, it doesn't matter. It doesn't matter.
The logical story hasn't been the right story, at least not now. And it's partly because of what's going on in China, due to the deceleration there and due to a shift to electric vehicles and beyond. Question is, are we still not out of the woods? And I keep thinking about what the CEO of Chevron had to say about that and the idea that we are eating down some of our inventories.
I'm certainly not saying Fatty B-roll's wrong. I'm just saying, sitting here this morning, who on earth in this market is listening to Fatty B-roll and saying, oh, that's concerning? Because they saw so many of those warnings repeatedly, one after another, through March and through April.
And you can tell by this administration, the president certainly prefers the diplomatic route. He continuously goes back to that. And even when he said the ceasefire was off and you pressed him, are we back to all-out war, he refused to commit to that either.
That's what makes this situation maybe a little bit more unsettling in some ways. Crude this morning, Brent around 85, WTI around 80. Up next on the programme, the resilient traveller.
Broadly speaking, I think the consumer's doing well. Certainly the higher-end consumers doing very, very well. Our international, travel season is looking very, very healthy. I don't see fuel prices deterring that.
Navigating sky-high fuel prices. We'll talk about the airlines with Tom Fitzgerald of TD Cowen. Up next. Later this morning, Scott Kirby of United Airlines. Looking forward to that conversation following decent numbers from them, record numbers in some ways coming from Brian Moynihan and the team over at Bank of America. We'll catch up with Brian at 8:30. Sprinkle of World Cup action. How many games do you reckon Brian's been to in the last 6 weeks?
Well, I imagine he's been quite busy, but I would hope that considering the fact, I would imagine based on these results that he's probably been somewhat busy. That said, considering the fact that they're the sponsoring bank behind the World Cup, I hope he got to some of them. I'm trying, I'm getting there.
I'll be disappointed if it's not at least 5.
Yeah?
Oh, I was going to say a dozen.
Well, I'm sure he'll be
at least 5.
I know where he's going to be on Sunday, though. And I think that he will be.
Can you imagine if he's not at the final this Sunday?
No, that'd be crazy.
He will be at the final. The question is, does he have extra tickets?
No. Yes. Who's he rooting for?
We'll try and find out. As a sponsor, can you pick a team?
No.
I don't know if you can. Haven't you got to pretend
deep
that
down,
you haven't got a team?
But deep down, you'll have a team.
We'll try and find out from Brian later, 8:30. Prepare, Brian. All right. Futures right now on the S&P 500, negative by 1/10. On the Nasdaq, we're down by 0.5. Really decent numbers out there again this morning, and this market is struggling to pick up, struggling to rally, even after 2 days of fairly muted gains on the S&P 500. Turn to the bond market, 2s, 10s and 30s. 2s really queuing off what happened with CPI and PPI, a bit softer than expected, particularly CPI much, much softer than expected. 4.15 on 2s. Lisa, we talked about it repeatedly over the last week. We've taken away the urgency to hike. We haven't settled the debate, and in some ways, Chair Walsh supporting that somewhat.
Yeah, and really talking about how he hasn't necessarily seen mission accomplished as the goal. That said, sounding a bit more dovish yesterday around the edges about AI, as well as just more broadly. We'll have to see, we'll have to study. The longer they have to see and they have to study, the more it benefits actually staying on hold, just simply because there isn't necessarily the data to support that. That said, and this is the anxiety that we have to deal with every single executive, how much does the percolating conflict in the Middle East change the backdrop should it persist?
And it does persist. And elevated crude prices persist as well. Crude right now, Brent around 85, WTI around 80. Not seeing a massive move, just another series of strikes and a commentary report coming out of the Wall Street Journal that maybe those strikes are expanded and the president is leaning in that direction. Now, look, is that part of the negotiation? Is that the signaling for the Iranians that this is what the president is thinking right now? You probably want to negotiate. I don't know. but that's the state of play.
Right. If you're the White House, this is the kind of news you want to get out there to reach Tehran. And according to the Wall Street Journal, it says options include stepping up airstrikes, sending ground forces to seize Iranian islands near the Strait of Hormuz, and bombing a fortified site that could be used for covert nuclear work. So if you're the regime right now and you have had waves and waves and waves of strikes, and this is the information that is starting to leak out of the White House in the Situation Room, you might start to have that debate amongst the elite that Norman Roule was just referencing earlier.
Brent crude right now around 85. Under surveillance this morning, navigating sky-high fuel prices.
Broadly speaking, I think the consumer's doing well. Certainly the higher-end consumer's doing very, very well. Our international, travel season is looking very, very healthy. I don't see fuel prices deterring that. I don't see oil prices returning back to the peaks we saw a few months ago. We're going to be fine. We're going to get through this period of time.
So here's the latest this morning. Strong travel demand driving up profit even as fuel prices soar. United, the latest to raise its outlook. Tom Fitzgerald of TD Cowen keeping a buy rating on the stock with the price target of 176, writing, "We believe investors should focus on the robust revenue outlook implied by the guide rather than the guide relative to stale consensus." Tom joins us now for more. Tom, welcome to the programme. We've heard from United, heard from Delta. What are your conclusions so far?
Demand is great. I mean, I think compared to what we were concerned about back in March and April, the quarter and the year is going about as well as can be. I think the fuel spike in the last couple of weeks is frustrating and kind of muddles the narrative a little bit. But the main thing in the North Star for the industry is unit revenue performance, and it's on fire right now.
And a big part of that is because they've been able to raise prices in a significant way without dampening demand, and they've restricted capacity. How much longer can they continue to raise prices in a capacity-constrained environment?
I don't think, fuel will swing it a little bit, but I wouldn't expect more price increases from here. I think the year-on-year run rate as we lap this will continue to go higher. And I think the name of the game right now is more about just maintaining this level of pricing and not giving it up like we saw back in the mid-2010s.
How much is their increased revenues really derived from the fact that they have constrained capacity in a dramatic way and are even considering continuing to cut just to keep planes full and to maximize profits?
I think that's a big element of it. I also think the fact that they're generally the premium mix shift, the fact that the cabin's much more segmented than it's ever been. I think the international boom, corporate's back. That's a lot of close-in bookings at higher pricing, so that really benefits them well. I think it's all of the above. I don't think it's any one particular thing.
This might be a stretch, so bear with me. But how much are the airline results also an AI trade? And I'll explain why. Because we're seeing, for example, aero defense come into play. A lot of that has been driven by new technology, and that's been a lot of the business travel. Financials also being a lot of the business travel. How much have the premium offerings been driven by all the activity that we're seeing at the banks and beyond that really has been funded by the capital markets?
Oh, absolutely. That's a big part of it. You can see it in the cargo over the Pacific a little bit. And I think another angle to consider is the wealth effect, just from the AI lifting the broader stock market and how that buoys, wealth-driven spending, especially from the baby boomer cohorts going to Europe kind of all year round right now.
When it comes to the fuel prices, especially in recent days, we have seen spot jet fuel prices start to spike once again. Who is going to be the best in terms of weathering this storm?
Delta and United, they have the best balance sheets. They have the most diverse revenue streams. I think they've proven to have the most resilient business models over the last couple of years already. And I think the airlines that will suffer will be the ones who are the most leveraged, who are going into this with already weak or negative margins.
When it comes to United, though, their fuel expenses were 84% higher year over year, more than $5 billion. Can they make this back up?
I think so. I think, look, if fuel is going to stay like 3 or above, in the 3 to 4 range, I think that's going to be tricky to really drive margins higher, barring another round of big price increases. But I think if fuel would start to normalize over the next couple, 12 to 18 months, I think then you see a lot of leverage in the model.
Tom, I'm just noticing a change in the conversation. Typically, we'd ask people about the airlines, what you like. They'd just pick one. They'd say Delta. More recently, more and more, we're all hearing the same thing. They'll say Delta and United Airlines. And United Airlines. Now, American Airlines is still not part of the conversation. Tom, just briefly, one, what has United done to be considered alongside Delta as best positioned right now? And two, what can American do anytime soon to be considered part of that group?
Yeah. I mean, how much time do you have? I mean, United, they leaned into premium in a similar way that Delta did under the current leadership team. I mean, we're coming up on Scott Kirby's almost 10-year anniversary on joining the company. The management team made really shrewd fleet investments, both in the planes that they've ordered and in the decisions not to retire planes during the pandemic. The similar thing with not furloughing pilots during the pandemic, like Piers, that allowed them to really lean into the strong demand, especially internationally coming out of the market. I think they've done a lot of things innovative on the customer experience side, whether it's on the app or some of their new products like the Relax Row or the block middle seat that's going to be coming on the A321 soon. So I think they're just kind of following. They realized that where the puck was going was all about unit revenue and driving a premium and decommoditizing the product and not a race to the bottom on CASM-X. In terms of American, I think they recognize that they maybe we're too focused on the cost side and at the detriment to revenue performance and revenue mix. And I think they're going about it to, you've seen a lot of premium investments. They're growing international quite a bit now as they take delivery of A321 XLRs and 787 Dreamliners. And that's an interesting play because they do look a lot like Delta and United, more like any other airline in the industry. And if we do see this strong environment where the industry can take price, you'll see a nice, almost a beautiful deleveraging on American where they could take net leverage down from 5x to 3x. So that we have a buy rating on them, and that's an interesting play as well, just a little more risk from the leverage.
How much is Delta maybe showing signs of not necessarily being threatened, but trying to defend their turf when it comes to some of the premium offerings versus United and even to a lesser extent some of the other airlines when it comes to the business basic, the idea that they have to compete more on price, even though that is the most profitable area and the area that's expanding the most dramatically?
I think it's also just a recognition that the customer mix who's sitting up front has changed. It's not as much focused on close-in business travel as maybe it was 8 years ago. And because you have premium leisure, a product like basic business might appeal to folks who maybe don't care about all the bells and whistles, but they want the lie-flat seat for a red eye or for a longer flight. But I think Delta, by virtue of how successful the business is, they're throwing off $3 to $4 billion in cash every year. They're able to reinvest and continue to maintain in this arms race, whether it's, their partnership with Amazon, which I think they can do a lot of exciting things on the loyalty side, not just on Wi-Fi, all the Delta One lounges that they're rolling out. I think they're up to 2 now in LAX. So, both of those airlines are very well positioned to compete with each other and further separate themselves from the rest of the industry.
Hey, Tom, it's good to see you. Thank you, sir.
Thanks for having me.
Fitzgerald there of TD Cowen. Thank you, buddy. It's good to catch up. American Airlines, my hopes were so high. I really wanted them to turn it around. It's been such a disappointment for so many people.
Yeah, and the real question there is how much is circumstantial with respect to some of the moves made during the pandemic of taking on a lot of debt and furloughing staff, and how much is execution. And these are some of the questions that increasingly people have been asking, and we're heading into earnings from that company.
I can tell you my own personal experience as both a family who spent a lot of money with American Airlines and personally through business spent a lot of money with American Airlines. Baby on the way, stopped traveling. Baby arrives, still not traveling. Some of the highest tiers of the company, haven't heard a single thing from them and haven't spent a cent with them for 12 months. And you won't hear from them. You can just disappear after spending tons of money with the company. Can you imagine that kind of relationship with any other firm?
Robert Isom,
right?
I suggest you send a message.
No, it's not about me.
Jonathan Ferro.
Imagine
Please,
how many,
where are you?
How many
Come
other
back.
business travellers have experienced the same thing
with
the company and then said, you know what, reset, no thanks, Delta, thank you.
Yeah, and they give handwritten notes when you come on board.
Right.
They're like things like that nature.
I've crossed over too.
It's not good. It's not good. Up next, we'll catch up with Jonathan Golub of Seaport, Katherine Thompson of the Cato Institute, KBW CEO, Tom Michaud, Oksana Aronov of JPMorgan Asset Management.
The inflation situation is extremely complicated.
I actually don't think that the U.S. does have a sticky inflation problem right now.
It's really what's happening to inflation beyond energy prices that's really going to matter.
Ultimately, in the longer run, if you have price stability, that's good for the economy.
The economy will heal itself. Inflation will heal itself at a measured pace if Washington just leaves it alone.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your price action scores look like this. Equity futures on the S&P 500 negative this morning by 0.2%, down on the Nasdaq by 0.6, even with some really good numbers in tech. SML yesterday, Taiwan Semi this morning. In the bond market, 2s, 10s and 30s. Yields pulling back over the last week or so off the back of softer than expected CPI and PPI, bouncing back this morning by 2 basis points, still around 420 on 2s, let's call it 415. On 10s up 2 basis points, still around 460, let's call this 457. With crude elevated, but declining somewhat through this morning, which is strange. We're down a few tenths of 1% on Brent. Likewise on WTI, around 80, even with a 5th consecutive day of strikes from the US on Iran. Coming up later this morning, we'll be talking about the data about 90 minutes away at 8:30 Eastern Time. It's jobless claims and retail sales. And based on the numbers we've seen so far from the likes of United, from the likes of Delta, this consumer is still spending.
Which is why you expect something around, I don't know, 215,000 for the jobless claims. In other words, steady as she goes, or even a bit of a reacceleration. We saw the same thing from the Beige Book, the idea of steady, if not expansion. And really the key is, how much are we going to get expansion without inflation? And does that support some of the trades that have really seen the biggest gains so far? Or potentially, is this not enough to meet the incredibly high expectations? Because as we have talked about all earnings season, the bar is incredibly high. And unless you leap above it and do a flip in the air, people are going to say, show me what else you got.
The bar is high because the numbers have been so great. We'll catch up with Scott Kirby of United later on this morning at 8:15. We'll speak to Brian Moynihan of Bank of America as well. Just go back a few months ago, let's say the middle of March, and I would say to you, in a few months' time, the airlines will come out and they'll be raising their outlook, and the banks will be coming out and they'll be minting money, and we'll be talking about record numbers on Wall Street, bank to bank, bank to bank. That's the situation we're in. Back in March, it was almost unthinkable.
Well, yeah, especially considering the fact that oil prices potentially were going to go to 150 as people were predicting. That didn't happen. Even still, though, I mean, the likes of United had a $6 billion cost with respect to fuel, and Delta had their biggest fuel bill ever. This isn't exactly like it went away. It's just that the momentum underpinning it has superseded that potential skepticism. You said something earlier that I think is really important, and this is sort of the dichotomy right now. On one hand, you've got this feeling it's as good as it gets. On the other hand, you have a real kind of wall of worry that's persistently there. Those two are connected, but also are they coexistent, right? Can you have as good as it gets if you still have people who are all really worried, or does that mean it can climb even higher? And increasingly, I think a lot of people are asking that question.
And I think also the market looks at a story like the Wall Street Journal with the president weighing whether or not to escalate the hostilities and airstrikes, and even thinking about potentially a ground invasion of Iran, as this is just a negotiating tactic right now from the President of the United States, a threat to try to get the Iranians to the table. What actually caught my eye this morning, what India is doing. There should be no deployment of Indian crew members on vessels undertaking voyages through the waterway, quote, until further orders. This is a country that's heavily reliant on the Strait of Hormuz, and they don't want any of their citizens operating any vessels that are trying to traverse the strait.
We have been conditioned by experience to believe this is just part of the negotiation, which is why crude is still closer to 80 than it is to 100 right now. Coming up this hour, we'll catch up with Jonathan Golub of Seaport as the AI trade faces a fresh bout of uncertainty. We'll speak to the KBW CEO, Tom Michaud, on the record-breaking quarter for the big banks on Wall Street. And Oksana Aronov of JPMorgan drops by, warning the Fed's hands are tied. We begin this hour with stock stalling as robust results from Taiwan Semi fails to add to the tech rally. Jonathan Golub of Seaport Research Partners expecting second quarter earnings throughout the market to exceed sky-high expectations, writing EPS is forecasted to have grown 23%. Using historical beats as a guide, earnings should finish between 25 to 26%. Jonathan joins us now for more. John, good morning. Good to see you, mate.
Good morning.
Let's talk about these numbers. And if we can take a step back, please just frame for our audience how unusual it is to see numbers this big, to see expectations climb this much into earnings season outside of a recovery from a recession.
The only time that you ever see earnings growth this big is when you are coming out of recession and you're comparing yourself to numbers that were incredibly depressed because you're in a recession. This just never happens. I don't know, is this a forced standard deviation event? This is kind of like once in a lifetime stuff. And it's not, we talk about the AI trade, but if you're looking at the numbers that are being put up by the financials, and we're not, we're talking about asset managers, we're talking about banks, we're talking about trading, this is extraordinary. If you look at the energy sector, on the back of the war. They're expected to deliver over 110% earnings growth. So it's not just one narrow group of companies and everything else is lackluster. It's really broad.
It's so unusual, John, that I think people are struggling to internalize it. What's happening here, and why on earth can this continue? Can you convince our audience this can continue?
Well, you raise this issue of it's not only how much they're beating expectations, but how much expectations are underestimated and keep getting ratcheted higher. So imagine for a second that I'm an analyst and I'm modeling a company out and I think this thing is going to grow 80%. Do I have the guts to go to my portfolio manager and say it's 80? So what do? I say, I think this is a 60% earner, and if I'm wrong, it's even better. And when you get a 75 or 80 or 90, you say, look, I got the call right, directionally I was right. And that's what's happening. The analysts, as great as their estimates are, they're actually being lowballed. The estimates are going up 50% year to date. I mean, we've never experienced this.
How much is this all the AI CapEx boom? And it just is being expressed in different ways, right? I mean, we're talking about the semis. They've taken some heat off in the past couple of days. But also the airlines, for example, people flying around to try to make deals tied to the AI sector. And frankly, they're wealthier because of the AI investments. I mean, is it the music still playing and everybody's still dancing, but someone's got to ultimately pay the bill and we don't know who it will be?
Well, it is all the AI story. And I think that's why the banks are putting up such big numbers, because you have to finance this. So the banks have to lend into it. Their companies are issuing equity. They're issuing debt. And so there's a huge amount of activity. And because the economy is running hotter as a result of this, people aren't defaulting on their loans because the economy is good. So therefore, the bank loan reserves come down. And so it is a virtuous cycle. And people's stock portfolios are up because of all of this. So there is a virtuous cycle. So if you ask the question, which I think you're asking is, what could go wrong? Anything that is a shock to the availability of credit to fund this stuff is a problem. The biggest positive news in the last week was that inflation numbers weren't worse. Because if the Fed gets forced to tighten into an environment that is just thirsty for capital, then you have a problem. And so I thought this was the most important thing, more important than earnings, was the fact that inflation is not being negatively impacted by all of this demand.
So, and we'll get to the inflation story in just a second and how this is a macro overlay that's really important that people need to watch. I just wonder who's going to pay the ultimate bill for all of this financing? Who's going to plug this gap over the next 5 to 10 years? Are we hearing from just the rank and file non-tech companies that they're seeing such return on investment that they're willing to keep paying up for tokens? Or are we hearing rationalization that threatens the overarching thesis?
So I think this thing is a two-phase process. The first one is we're building out the data centers, we're building out the infrastructure in order to make this possible. But the actual efficiencies, let's maybe think about this in innings. We may be in the 4th or 5th inning in the build out of the AI infrastructure and CapEx boom and all of that, but we're only in the 2nd inning of the efficiencies that we're going to get on this. And here's the truth. We don't really know what those efficiencies are going to. We know it's a big deal, but we don't know exactly how big, and we don't know whether we're going to have 1 million winners or whether these are going to consolidate it. And just like in other areas in the financial industry where there's only 1 or 2 final winners and then the others end up not fully participating.
Are we really building out data centers? Who else is going to follow Governor Hochul and put moratoriums on these?
We have to do that. And the fact that the government may be pushing back on this, at the end of the day, there's demand, there's insatiable demand for this. And if we don't do it, first of all, if we don't do it, foreign governments are going to do it on their shores, and they're going to beat us at a very important game. States that are going to do this are going to be at an advantage. And it's not only the data centers, but it's the electricity infrastructure for this. It's going to happen. It's necessary. And anyone who tries to kind of, to stop this or put their thumb in the dike to stop the flow is making a mistake.
I totally hear you, but we're up against a midterm election and a massive presidential election in 2028. And this is going to be the biggest issue. Isn't this a huge risk for this entire trade?
I don't think so. I think that ultimately she's going to have to answer, to the voter base, which is why is New York not friendly for the future of technology? And if New York's not going to do it, I can only imagine that people who are campaigning in Florida or in Texas are going to say, come here and do business because we're willing to invest in these things.
Unless you've been long semis, and Bramo, this is the issue, to your point, this is the political dilemma right now. You haven't seen the benefits of the CapEx, personally. Through the wealth channel, without a doubt. If you've been long the equity market, you're doing fantastic. If you're associated with these business, you're doing brilliantly. But for the average person on Main Street right now, and it speaks to sentiment, which is completely rock bottom, and I'm not saying that's material for the equity market. That's a different conversation. But I think for the politicians, they can see the numbers are decent, GDP is sky high, the contribution that's coming from CapEx is really large, but the average consumer on Main Street right now is not feeling it. And that's why it's easy to come out and say, you know what, no more data centres, because that's the kind of thing that might be popular for now.
And to the extent that they're feeling it in higher energy prices, or you're seeing that energy plants can't keep up with all of the demand necessary because it's really hot and smoky and disgusting out, and so you've got to stay inside and filter your air and have air conditioning. Well, they're running out of the capacity to also have the air hopes and dreams. It's going to be a really interesting question. You got to have a better PR attitude also than some of the founders of some of the tech companies talking about how it's going to render humans completely irrelevant, because actually that's not what we're hearing from the CEOs, and maybe they're just doing a messaging exercise. There's a real lack of trust right now because of the lack of certainty.
The PR's been better from Jonathan this morning.
I think that it's
than it has from Anthropic.
Yeah,
right. It's been horrendous from Anthropic. We're going to take all your jobs, and we're going to push up energy prices, right? It might help your valuation. I don't think it helps the broader story.
The interesting thing is when you talk to CEOs, they're not finding it to be that big of a cost savings. They can't even identify how much of a cost savings it is, because what they're doing is anything that they save from efficiencies, they're pumping into more investment. So it's turning into a very expensive proposition. The ROI is going to be very hard to prove, and this is one of the sort of flies in the ointment, which, again, when do you start seeing the breakouts that can justify how much they're spending?
Can we finish on that point, Jonathan? What's your response to that, the ROI situation? Because we have, anecdotally, we've seen individual companies, started with Uber, I think, that individual companies are starting to rationalise spend on some of these things. I think we heard from JPMorgan this week, telling employees, based on reports, to focus on the more complex things. Don't use this for basic tasks. What does that tell you about the situation we're in?
Well, I mean, when we're talking to companies, the first thing that they're saying is, it's really great. It helps me build a PowerPoint presentation more quickly. And if you look at that, that's like saying, you know, I can do a Google search that's a little bit better. That's not really where the benefits are. The benefits are to rethink industries in a way that we couldn't even imagine before. And there are some folks who are doing that, but that's going to be a multi-year process, and we don't know what the winners and the losers are going to be on it. But I'll tell you right now, there's companies, they have no choice but to play. And so I agree with Lisa's point. I don't think you're going to see this massive wave of layoffs, because, first of all, companies have to invest in the security around this stuff, because they have to make sure that their businesses are rock solid. And if they do transition their computer systems over, that there's no disruption. And so right now, I just don't see a wave of layoffs. I do think that you're going to see change in business models going forward, but it's not right now.
Good politics is not necessarily good policy. You mentioned that earlier on this week. It's not a great message to sit there and say, if you're Kathy Hochul, we want to build a data centre the size of Virginia so the first-year analysts on Wall Street can make a PowerPoint presentation faster. That's just not going to really work, is it? In any way, shape or form. What's fascinating is the market response. When you talk to bankers, they say this is the bull case for all infrastructure-related debt, because there are going to be policy constraints on it. So our infrastructure that we do now is going to be all that much more important. And you've seen a lot of front-loading. So there is that case in markets. You know, you can make anything into a positive. John, it's good to see you. Thank you, buddy. Good to see you. What an earnings season. Jonathan Golub there of Seaport Research Partners. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Fed Chair Kevin Warsh says President Donald Trump hasn't tried to interfere with central bank policy. Answering questions from the Senate Banking Committee, Warsh saying, I've told the President and Treasury Secretary they chose an independent guy to do an independent job, and that's what I plan on doing. Japan is planning to buy more than 27,000 NVIDIA next-gen Rubin chips to build a homegrown foundational AI model for robots. It's part of a series of efforts by the Japanese government to lower its reliance on foreign technology and bolster national security. United Airlines posting second quarter earnings that topped estimates. The company expecting resilient travel demand to drive up full-year profit despite soaring fuel costs. United CEO Scott Kirby joining Surveillance at 8:15 Eastern. And that's your Bloomberg Brief. John.
1 hour away. Vonnie, thank you. More from Vonnie later on this morning in about 30 minutes' time. Up next on the programme, ramping up attacks on Iran.
They want to settle so badly. They don't like what we're doing, and they do want to settle. We'll find out whether or not we settle with them or we just finish it off. The country is booming, and we'll have Iran defeated soon.
Up next, we'll catch up with Katherine Thompson of the Cato Institute, live from New York City this morning. Good morning. We're lower by 0.25% on the S&P. On the Nasdaq, bit of a sell-off emerging here. We're down by 0.8%. Won't make too much of it. We've bounced back from those kind of levels before, but the tape is a little bit weaker, softer, lower, negative, even with some decent numbers in the tech space, which tells you a lot about things going into earnings season for the big tech players in a few weeks' time. That we heard from Samsung out of South Korea a number of weeks ago. That was the first tell. Great numbers. Stock didn't trade well. ASML, Taiwan Semi, decent numbers. Stock market on the tech side of things, a little weaker.
Yeah, buy the rumor, sell the news, because ultimately people have already priced this in and then some. It's just how high can the bar get and can they cross it? And ultimately, is this just about, okay, you guys are solid, now we can shift our focus to the more undervalued areas? Because yesterday we did have record highs. It wasn't as though we're not making new records, particularly in certain areas. Just a lot of volatility under the surface.
Let's turn to the bond market. Yields higher by 2 basis points on twos. Your 2-year just short of 420. 415, 10's around 460, crude elevated. Here's the move in crude. WTI and Brent down by a few tenths of 1%, but still around 80 on WTI, around 85 on Brent crude. And the prospect, this is the issue right now that this market has got, the potential that this limited action in Iran becomes something bigger. And we're trying to figure out, is that just part of the negotiation, or are we setting the stage for something broader, wider? The market right now is not going to believe it based on the conditioning we've had through the experience of the last 3 months.
I'm reminded this morning from a viewer about how there was a story March 26. Pentagon prepares for massive, quote, final blow of Iran war. We have been here before when it comes to threats and leaks out of this White House, potentially to try to get the Iranians to the negotiating table. At the same time, last year, the president gave the Iranians months to try to come to have a talk about nuclear. And at the end of the day, they didn't, and he went forward with bombing them. So there's been examples of this president getting fed up and actually taking more of that red line, nuclear option. Is this one of them? We don't know yet.
Let's talk about the latest in the region. Under surveillance this morning, ramping up attacks on Iran.
They want to settle so badly. They don't like what we're doing, and they do want to settle. We'll find out whether or not we settle with them or we just finish it off. The country is booming, and we'll have Iran defeated soon. A lot of people thought oil would go up to $350 a barrel. It went up a little bit because I had to take tough action. When that settles down, I think you're going to have $55 oil.
So here's the latest. Crude little change following a 5th straight day of attacks against Iran. The US striking a sanctioned oil tanker bound for Karg Island. Tyler Kendall joins us for the latest from Washington. Hey, Tyler.
Hey, John. Well, this marks the first time that the U.S. military enforced its naval blockade since reinstating it earlier this week. But this strike against this vessel actually happened deep into the Persian Gulf, away from the Strait of Hormuz, seeming to indicate that the U.S. is looking to expand the scope of its naval operations. CENTCOM says that it is actively working to help secure shipping, confirming that overnight it assisted at least 10 ships that were transiting through the Strait of Hormuz. But we're seeing the impacts already in the data. The 7-day average for oil flows has fallen from 4.6 million to 3.9 million barrels this week, according to RBC Capital Markets. And it's numbers like these that are sending those alarms to this White House to take potentially additional action. As our reporting indicates, the administration is now considering extending that Jones Act shipping waiver in a bid to help oil flow more freely when it comes to imports in this country, because escalation is, of course, very much on the table. We've heard President Trump threaten that they could go after Iranian infrastructure. And now the Wall Street Journal reporting that he is leaning towards expanding military operations, including potential boots on the ground. Though, John, we heard from the Vice President, J.D. Vance, yesterday, seeming to dispute that the U.S. is looking at additional ground forces.
Tyler Kendall with the latest. Tyler, thank you. Katherine Thompson of the Cato Institute writing the following: the resumption of significant military action, including enforcement of a blockade, is an incredibly disadvantageous state of play for the United States. Katherine joins us now for more. Katherine, is it advantageous for the Iranians right now?
I mean, I think it is. Obviously, the Strait of Hormuz has been the biggest leverage point for the Iranians, and we're seeing them use it. I think obviously they are potentially going to take some blows if the threats of escalation, as the president have laid out, which we have to take seriously, come to fruition. But I think for the longer term strategic horizon, it puts the U.S. in the most disadvantageous position.
When you see that story in the Wall Street Journal, do you think this is a threat from the United States to try to get the Iranians to the table? Or do you think the president is serious and within weeks we could see a serious escalation when it comes to the conflict?
It's hard to say. I mean, as you guys pointed out, right, we've seen examples on both sides of the equation where, the president has sort of done this dance before and both sides have been true. I think anytime, right, the president is putting this risk of escalation and signaling risk tolerance at such a high degree on the table, we have to take it seriously. But I think I would imagine, right, if I was in those conversations closed door with General Kayne and the other military leadership, I would imagine he's also hearing about not only the risks to U.S. personnel and U.S. forces, particularly on any sort of ground invasion that could come with really significant casualty numbers, but then also on our munitions expenditure, right? You had the president and General Kayne in Philadelphia in Pennsylvania this week discussing, the need for defense contractors to move faster because of the munitions crisis that the U.S. is in. Exacerbated military action with further escalation, again, comes with really big strategic risks for the United States to expend more of our critical munitions that we don't have. I mean, there's not an endless supply. And so this is a real trade-off dynamic, for that sort of threat. So maybe it is a negotiating tactic, but every time you put it on the table, you got to take it seriously because of these other strategic elements that we have to contend with.
Katherine, how low is the United States on hardware?
I mean, it's hard to say based on publicly available numbers because we're obviously not getting real-time reporting. But I think the latest from CSIS and other think tanks here around Washington obviously indicates that we are significantly low, potentially have depleted around half of our stockpiles that were present at the time of the start of the Iran war for many of our critical munitions, within the first short stretch of this conflict. Obviously, further military action in the region that has U.S. bases taking incoming fire is going to put us in a position where we potentially have to expend more. And then you have reporting that, to replenish munitions just to pre-Iran war levels could take anywhere for some of our most high-value munitions, anywhere from a year to 4 years on a time horizon. And that's not even contending with getting our stockpiles back to the health that they were before we depleted them to arm Ukraine. And so, and that's the factor that I haven't seen many reports around Washington take into account. And so, I mean, I think these numbers are significant. And that's why, I mean, they're a serious part of the conversation on any further U.S. military action.
That's exactly what Lisa was talking about earlier this week. Katherine Thompson there at the Cato Institute. Katherine, thank you. To your point, Bramo, some people think that has really shaped the approach, the timeline to this situation with the U.S. and Iran.
The nature of war has changed. You used to be able to hit 8 targets in a day, and that was a good day. Now you can hit 1,000 in real time. And so it's not a question of, whether you execute those hits. It's a question of strategy that goes into game theory that is a very different calculus because you can run out of ammunition faster than you can switch strategy or even respond to the ramifications of what it's having on the ground.
Are we blaming Anthropic for that or thanking Anthropic for that?
Yes, why not?
Right.
It's Project Maven in action.
Yeah.
Basically. Up next on the programme, KBW CEO Tom Michaud on the record-breaking quarter for the big banks on Wall Street. Plus, Shahira has your morning movers. United Health raising its outlook following an earnings beat. That stock is up 7%. Brian Moynihan of Bank of America joining us later. I'm taking hits off the side of the set on England losing yesterday.
Well, do you want to respond?
From our next guest. I'm not going to respond.
No, I won't.
Is that what are we trying to do? Is that how you start a conversation with me this morning?
Absolutely.
No,
just say,
I actually think getting to the semi-finals was pretty good. It would have been nice.
Let's just start with good morning. Good morning.
Double whammy for Jonathan. Italy, England.
Okay. No more football. Brian Moynihan of Bank of America on later. Looking forward to that.
Football. Yeah.
At the end of the conversation.
So ask him.
Go on, Tom.
Ask him about sustainability. Say, hey, look, the company's driving higher levels of profitability. Is this the new normal?
You're right in our interviews now, too. We're live. Right, get going. Equity futures right now in the S&P look like this. Futures in the equity market on the S&P 500, negative 0.2%. We will ask Brian now. He'll join us in about 60 minutes from now. The stock yesterday closing at an all-time high. JPMorgan at a record high. BNY a record high. Morgan Stanley, Goldman Sachs closing at all-time highs. That sector delivered fantastic results. This equity market is down a few tenths of 1% this morning, but it's pulling off 2 days of gains in the last few days.
Yeah, especially given some of these results that shattered estimates. I don't think that you have enough superlatives to talk about just how blockbuster this quarter was, driving just a profitability that we have not seen before from these big banks. The key question is, as Tom said, the sustainability. How long is the pipeline? How much can it continue? And how susceptible is it to macro concerns? Nobody wants to hear it. They want to go on vacation and celebrate.
Tom, we'll come back to you in a moment. Stand by. All right? Maybe. In the bond market, 2s, 10s and 30s, yields look like this. The 2-year, 4.16, yields up by 2 basis points. 10s higher by 3 in the commodity market. Pushing some of the move, really. The persistence of this now is becoming a problem. Brent around 85, WTI around 80.
So you have massive waves of strikes happening last night, the latest one ending at 9 p.m., going after these military installation of Iranians that are targeting commercial vessels. Both sides are really signaling that they will continue the hostilities, and they're waiting for the other side to blink, which is why you have this story in the Wall Street Journal getting a lot of attention, even though it's not really moving the market, that the president is weighing whether or not he is going to step up airstrikes, and even weighing if there's going to be potential of ground troops.
Market participants we speak to just believe that is part of the negotiations. We'll see if they're right. 84.58 on Brent. 2 hours away from the cash open. Let's get you some morning movers. Yahara has more. Hey, Yahara.
Hi, John. We start with some deal news having to do with Eli Lilly. It is buying the psychedelic drug maker Atai-Beckley in a deal worth up to $3.8 billion. And of course, while most people know Lilly for its blockbuster weight loss drugs, this is an area that it's also known for with its treatments like Prozac. But it's just the latest in a string of pharmaceutical deals we've seen lately, which of course has driven capital markets activity and the deal making on Wall Street. Atai-Beckley shares soaring 34% in the pre-market. And I want to take you through the earnings that we've gotten this morning. GE shares are falling 4.3%, even after it posted a beat and a raise. And its results really line up with what we've been hearing from the airlines, that demand has been strong. So they need more engines and more maintenance, and that benefits GE. But with shares up about 12% year to date, the bar was pretty high for them. The bar was also high for United Health, and its shares are rallying up 7% in the pre-market. It delivered a beat and a raise, and a big reason why is it paid out less in medical costs than Wall Street had expected, and giving investors more confidence that this turnaround is taking hold. John.
Yahara, thank you. More from Yahara in the next hour. On our radar this morning, TSMC ramping up spending following a 77% profit surge. The chip maker signaling that demand for chips and data centers has further room to run. Elsewhere, the US launching strikes against Iran for a 5th straight day, hitting a sanctioned oil tanker near Carg Island.
They want to settle so badly. They don't like what we're doing. And they do want to settle. We'll find out whether or not we settle with them or we just finish it off.
The Wall Street Journal reporting that the president discussed seizing Carg Island in a meeting just yesterday. And finally, the Fed chair, Kevin Warsh, keeping an open mind on AI.
Will AI eliminate jobs at a catastrophic rate?
Over the long term, absolutely not. This is a long-term job creator. Will it increase measured prices over the course of the next 12 months? I suspect it will be. But whether that's inflationary or not, that's up to the Federal Reserve. This is one of the good family fights.
Another good family fight with Kevin Warsh and the family over the Federal Reserve. Bramo, this is what you took note of just yesterday.
Yeah, the family fight is lining up like this. You have Kevin Warsh skeptical that long term this will be inflationary, even over the medium term, and that there will be efficiency. John Williams on the other side talking about how AI demand is now his main inflation concern. Alberto Musalem casting real doubt on just how much the efficiency can bring down inflation that is currently in the system. Chris Waller also talking about this to some degree. So there's your family fight, expected to continue.
And the minutes from the last meeting showed us that they already had this family fight. When you look at the minutes from the June 16th, 17th meeting, quote, many of the 19 officials said that the, quote, ongoing strong demand for AI infrastructure would likely sustain upward pressure on prices for technology products and electricity. At what point will the Fed actually decide whether or not it is inflationary or not? And Kevin Warsh just said it's for the Fed to decide. So he almost gave us a little bit of insight into they will come out with, well, a paper, a speech.
Yeah.
Some sort of conclusion.
We'll get more data later this morning. We'll get jobless claims and retail sales. Look out for that at 8:30 Eastern Time. Let's talk about the banks. Wall Street's biggest banks delivering blowout results. Goldman Sachs beating its own record for equities trading revenue by more than $2 billion. JPMorgan, Morgan Stanley earning more in the second quarter than ever before. And Bank of America notching a record first half for its sales and trading division. Tom Michaud, the CEO of KBW, a Stifel company, writing banks are benefiting from positive operating leverage, accelerating loan growth, strong credit quality and significant share repurchases amid signs of a healthy economy. Tom joins us now for more. Tom, good morning.
Good morning.
Let's do it properly. We'll start again. It's good
Great
to see you,
be
buddy.
with you.
Hey, thanks for coming back. Thank you as always. They've crushed it. Is it just capital markets or is it more than that?
No, it's more than that. I think the banking industry's hit a new level of profitability and has a chance to even do better. Now, the ones with investment banking operations that you just mentioned, this may be a high bounce. It may not be repeatable. It could be in the next quarter, but I wouldn't expect this to be the new run rate. But I think the underlying profitability industry's absolutely been getting better, and that's really the core story here.
Let's talk about it. Operating leverage. We talk about these things so many times. Where's it coming from? Where are these improvements coming from?
Well, the first thing is that having zero interest rates, which is what we had, was unnatural. Banks weren't designed to be very profitable in that environment. An inverted yield curve is hostile to banks as well. So that's been fixed. And then you've got the regulatory shift. And I don't think it's really releasing regulations right now. I think it was the intensity of the regulations we had before being reset back to what I think is more originally intended. And that is absolutely unleashing growth. I think it'll have implications for bank versus non-bank market share. And so I think it's look, big bank stocks have been outperforming the market since October of 2023. They're 80% of the head of the market return year to date. I think the conditions still exist for banks to outperform. And now the regional banks are starting to catch up. And that started in the fall of last year. So we've got, I think, a longer cycle here of outperformance.
Can you elaborate on that? How much of the boon time type of activity that we've seen is a result of big banks winning share back from alternative asset management?
I would say that's just beginning and it can run longer. I mean, I think the story, so if you're kind enough to have me back in 5 years, okay?
Of course we will.
So the story we're going to talk about is the fact that private credit had a once-in-a-lifetime growth spurt during COVID when interest rates were zero, and it couldn't be replaced. So really, and that was happening while the banks were still being hammered by policymakers not to grow. That era is over. So now the shift is going to come back. That doesn't mean the banks are going to go make 7 times levered loans tomorrow because they think it's a good idea. But they're going to start clawing back some of their market share, and it's going to happen over time. The big 5 that reported on Tuesday had enormous residential mortgage growth on a percentage basis. In the last few months, Vice Chairman Bowman is leading a charge to release the very strong constraints put on banks after the global financial crisis, when the market share in residential mortgages literally fled the banks, which is what they were originally designed to do. It's starting to come back. So I think it'll be more of a slower shift, and I think it's good for the economy. I think it could be done responsibly, and I think it's good for the U.S. and the global standing. And I think Europe has gotten the message, and now you're seeing bank M&A start in Europe because they realize how far their banks fell behind. Not that they're bad companies, but they had an anti-merger policy across country lines. And so their banks just couldn't play on the global stage anymore.
So here's the question that Jamie Dimon asks. Is this as good as it gets? Because you've got the regulatory side of things, winning back share. You've got the M&A and IPO cycle and debt issuance cycle all just going gangbusters. And you have a consumer that's okay.
So
you're not seeing delinquencies.
I think I know the reason what will take the steam out of it, and it will be credit quality. Because in our models for the industry, we've got 21 basis points of provisions for the quarter. No way is that the number through the cycle. So the industry's over-earning on credit. credit costs tend to come immediately. You don't think about it, you got to pay for it right away. So the view is that the industry's over-earning on credit, it's over-earning some on tremendous investment banking results, but it's also under-earning on its capital position, because the capital of this industry is the highest it's been in decades. So if you go back to pre-global financial crisis, the purest form of the capital ratios was about 6.5%. Our models show it'll be 9.7 at the end of 27. So the industry's got all this capital. What is it going to do with it? It could grow organically, which is what I think policymakers would like them to do, help the economy grow, raise dividends, buy back stock, and buy each other, and compete with non-banks. So I think this financial services sector, I mean, we saw the news about PayPal yesterday possibly being in play. Financial services is kind of exciting. All these companies are bumping into each other. My favorite press release of the last few weeks was Morgan Stanley announcing that they were going to undercut Robinhood on crypto trading fees. So that's the old sheriff letting everybody know they can still be the new sheriff.
Thank you for ranking his press releases.
Press release.
Exactly. Who doesn't?
Right. Help me invest. Do I trade this as a group? Or is this still a stock picker story?
It's stock picking.
It doesn't feel that way right now, so just explain that.
Well, first of all, I think the whole group can do okay, but I do. So I heard from investors going into the quarter, and you think of someone like Goldman who had a blowout quarter, right? But when you look at their business mix, it is generally more dependent than Morgan Stanley on strong markets. Morgan Stanley spent a couple of decades building more fee income businesses, and now they're being rewarded for it. So that's why we like Morgan Stanley more than we like Goldman at the moment. And so, yes, you can't go by. The whole group, I think, has got wind in its sails. Our favorite stories are the return on capital improvement stories. We still like Citigroup, even after the sell-off after earnings. We like KeyCorp, which is an improvement story. Citizens Financial, which I think might be reporting tomorrow, I think they report. Stocks had a great run, but they're a profitability improvement story. So those have been more of our favorite stories. And we like Bank of America. You've got Brian on. We think this improvement story at Bank of America, it has legs to it.
Got more questions for Brian? You can share them now.
I didn't realize
them.
They had a great quarter. What comes next?
Sometimes I'm so casual off the top of the break that people don't realize we're live on TV.
I didn't realize we were live.
I got the feeling.
Yes, we're going to talk more about World Cup soccer, I thought. But I would just talk to him about the sustainability and durability. And look, I think the market has to stop thinking of some of these companies just as banks. Bank of America is a financial services company. And you look at where Capital One is going, which is a company and a stock that we like, and American Express. These are I think they're some of the global gems of companies. And now they're going to start competing in each other's businesses because the fintechs are coming. And if you don't do that, you're going to miss out. I don't think these boardrooms are thinking about how can we be a really good bank. I think they're thinking about how can we make sure that we're involved in the payments conversation, that we're involved in what happens to stablecoin, that we're aware of blockchain. And a lot of the businesses in America, like consumer banking, it's becoming a mass market business. It's not a small town business anymore.
Some acquisitions across financial services?
I think we're going to absolutely.
Not just between banks.
Oh, we're absolutely going to see
Just describe that, what that might look like.
Well, so we'll talk about investment banking. So you're seeing companies like Citizens Financial, KeyCorp, and others building investment banking operations for their middle market clients. Now, this is on a smaller scale. They're not going to try to go compete with Goldman and JPMorgan. They've got a 100-year head start in some cases. But they are going to offer more services to their clients. Then also payments. I mean, Fifth Third is an industry leader in payments, for example. And so when you go to a fintech to go do something, there very likely is a bank behind it, and it might be Fifth Third. So I think it's a collision. I think, while I'm in the investment banking business and research business, I'm like going to be a traffic cop watching a collision of all these companies, like I mentioned with Robinhood earlier, with crypto trading. And look, you go to the website of Coinbase and Robinhood and check out what they're offering. Those are good companies. Do not underestimate them.
Tom, it's good to see you.
Great
You're
to see
welcome
you.
back anytime. Don't wait 5 years.
Thank you. And I can't come shortly after an England loss in the World Cup.
We won't do that again.
That was. I see the Yankee Cup over with Annmarie. I should probably stay there.
Yeah, and the Knicks. You like the Knicks?
The Knicks. What a great year in New York.
Epic.
What a great
It's been
year
a
in New York
fantastic
for
year,
the Knicks.
without a doubt.
And Male Athlete of the Year award he received this week.
Oh, really?
Jalen Brunson.
Okay.
He deserved it.
Before the World Cup's completed, he gets the Male Athlete of the Year.
Yeah.
Okay. Who awarded that prize?
And I think
Who awarded that prize?
What is it called? The ESPYs?
That's what it was.
Yes.
That was the ESPYs.
And Play of the Year, OG.
OG?
Game 4.
Knicks are on a
Yeah,
roll.
the Knicks annihilated that whole
I know you're going to
game.
go to another
Guys,
segment.
I'm sorry,
when
but for people who love international sports, that's ludicrous.
Yeah, I'm going to bring up the New York Jets, which means you're going to probably go to another topic. But I'm hoping that we'll get another New York team to come out of its,
I don't know about that.
its long winter.
Tom, thank you, sir.
Thank
you. Tom Michaud, the KBW CEO. How do you give it to...
Well, because the ESPYs were already scheduled.
How do you...
Yeah, give the ESPY to the Messi.
Right? Like the World Cup's still on.
Yeah.
Well, he might get his ESPY on
The most
Sunday.
popular sport on the planet is still being played. Let's get you an update on news elsewhere this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
John, hey, President Donald Trump addressing the nation tonight at 9. He's expected to discuss a variety of topics, including elections and voting machines. The president telling radio host Hugh Hewitt the speech will be similar to those he gave at Mount Rushmore and the National Mall earlier this month. President Trump's nominee to become the Director of National Intelligence facing a tough confirmation hearing on Capitol Hill. Jay Clayton repeatedly sidestepping questions on whether Joe Biden won the 2020 election. Democrats saying his refusal to answer shows he wouldn't be willing to contradict the president. Air quality dropping to unhealthy levels in Manhattan. A smoke from Canadian wildfires blanket the northeast. Experts suggest reducing or eliminating outdoor activities, wearing an N95 mask and shutting all windows. And that's your Bloomberg Brief, John.
Vonnie, thank you. It's not much of a prize, though, is it? We're still arguing about this.
I know.
You're not,
It's
not Athlete of the Year, then, are you?
It's not an international. I don't think it's an international
So
award.
the American Athlete of the Year.
Look, there's
Okay.
lacrosse players that are up for some of this. Wrestling, Duke basketball
Sure.
athletes up for it.
I get it.
It's domestic focus.
It's like saying you've won the World Series when it was only played in one country.
That's not
you
true.
know? You know?
Canada.
Oh, of course.
Unless you subscribe to the
Truly
51st
global.
state.
Truly global. Up next on the programme, the long fight against inflation.
Inflation is a choice. The members of our committee have no tolerance for persistently elevated inflation, and we share a resolute commitment to restore price stability.
Oksana Aronov of JPMorgan joins us next. Live from New York, welcome to the programme. Under surveillance this morning, the long fight against inflation.
Inflation is a choice. The members of our committee have no tolerance for persistently elevated inflation, and we share a resolute commitment to restore price stability. What the Fed's looking for is economic strength to broaden and the inflation that we talked about earlier to become more narrow.
So here's the latest this morning. Wall Street awaiting more data and Fed speak after a string of cooler than expected inflation prints. Retail sales, jobless claims dropping at 8:30 Eastern. We'll also hear from the Fed's Logan, Schmidt and Jefferson. Oksana Aronov of JPMorgan Asset Management writing, the Fed is in a late cycle trap. Now its hands are tied. Oksana joins us for more. Oksana, good morning.
Good morning.
What does that mean for this Fed? They can't do anything for the remainder of the year.
They're in a really tough spot, which I think you could have seen coming. And we certainly, have spoken over the years a number of times, and we said, look, we think the Fed is too early to cut here. When they started cutting, long rates haven't responded to this. And now they're in the place where you have this inflation that is, legitimately stuck even after the softer print. I think everyone agrees inflation hasn't really been going where the Fed would like it to go. And what do you do here? Hike. The bar for that was always very high. That's been taken off the table, understandably. Cutting seems absolutely reckless. And so they're having to kind of just sit here and watch this develop and don't really have a lot of tools at their disposal, which was the reason for why I think they started too early.
So as an investor, you're not sitting on your hands. You're looking across the yield curve right now. Treasuries, 10s offering 4.60, 30s around 5, even at the front end of the curve, nicely above the policy rate at the Fed. Are these levels, these yields, these rates a buy?
Not at the long end of the curve, they are not. There are several dynamics unfolding at the long end of the curve. First of all, let's examine why rates haven't really been receptive, or why this economy hasn't really been receptive to Fed's policy of tightening, right? We didn't see a meaningful slowdown because predominantly the stimulus is coming from AI-related spending and wealth effects. It's coming from the fiscal spend. Neither of those things are very interest rate sensitive. And so we've continued to see the economy remain resilient, and we haven't seen inflation relent for that reason. And also at the long end of the curve, you now have predominantly demand coming from foreign investors who like the relatively elevated nature of our rates compared to elsewhere. And you also have, of course, these concerns about inflation. And long rates seem to be really responding to inflation concerns, demand, supply-demand dynamics for treasuries, and certainly the condition of our fiscal spend, which is only accelerating. So it's really hard to imagine that anything constructive will happen there in terms of, a significant rally. So I don't think that's a buy. And we're seeing investors, certainly retail investors, and even, what's happening really in the markets is that the retail investors are staying at the front end of the curve, understandably. And then the insurance and sort of larger institutional investors are increasingly buying assets in the private markets because they're getting pretty good yields. And we can debate whether that's a prudent strategy or not, but that's been really the game. And so the long end of the curve really depends on that foreign buyer.
Talking about the foreign buyer, how much are you worried about Japanese investors reappropriating assets back home and policies to even support that kind of effort coming from the Ministry of Finance?
So the Japanese market was always a very domestically oriented market, and that's one of the reasons that has helped Japan's yields, held them so low for so many years. So it wouldn't surprise me if that repatriation, gained steam. On the other hand, you've had China being the other major supporter of treasuries, and their treasury assets are, there's this question out there, what happens if China sort of dumps their treasury? Well, what's been happening is their treasury assets have gone from something like 1.3 trillion down to about 700 billion. So that process is happening quietly. And so while there's no sort of alarm that's imminent, I do think it will become an increasingly significant issue in the coming years, frankly, especially if our rates actually do start to go lower. Are these buyers going to be equally interested in continuing to support them?
Just quickly, where does that leave the Europeans and the European bond market?
So the European bond market, the European economy generally is struggling for a number of reasons because you don't have the dynamism, of course, of the U.S. economy. And I think the Europeans are onto this, and they're trying to make some changes. They're just exceptionally difficult. For the bond markets out there, the issues are somewhat similar. You do have inflation concerns as well. You saw the ECB take measures with respect to that earlier this year. So I think some of the concerns are similar, plus growth is just not there in the same way that the U.S. has experienced it, right? The German economy hasn't grown at all in a number of years, for one. So you have this, I think, stagflationary scenario that is maybe a touch higher. So European bonds being a buy, probably not, although certainly there are always isolated opportunities. Nothing is ever sort of an across-the-board no or an across-the-board yes.
Oksana, good to see you. Welcome back anytime also. No football jokes. Oksana Aronov of JPMorgan Asset Management, unlike our previous guest. Up next on the programme, big hour coming up. We'll catch up with Julie Biel in just a moment. Then the United Airlines CEO, Scott Kirby, and Bank of America CEO, Brian Moynihan. All of that in the next hour on Bloomberg Surveillance.
The underpinnings of this market are still in decent condition. The big story is earnings.
The reality is the earnings prospect remains very positive.
Right now, you're seeing so much earnings growth within these semiconductor names that it's a question of how sustainable they will be.
You're probably going to see companies continue to be cautious about the outlooks for Q3 and the rest of the year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. A big third hour of Bloomberg Surveillance coming up right now with your equity market looking like this. Your scores as follows. Equity futures on the S&P 500 negative by 0.25% on the Nasdaq, down by 0.8 on the Russell. We're down by 0.4 in the bond market. 2s, 10s, 30s. Yield shaping up as follows. Up 2 basis points on 2s, up 3 on 10s. Your 10-year around 460 this morning. With this move in crude, WTI and Brent elevated but just about unchanged. Brent crude around 85, WTI around 80. Next stop for this conversation, the data, 29 minutes away. We get retail sales and jobless claims at 8:30 Eastern Time.
With the expectation being ongoing strength, as we've seen from all of the earnings, and the earnings have been incredibly robust. Key question, how much is this all the AI trade, and how much are we going to get the participation of the broader economy? That's been the underpinning question. On one hand, really good news, disinflation. We've gotten that from CPI and PPI. Can you get ongoing strength in the consumer without inflation? And this is the conundrum. Or are these swirling stories of macroeconomics paired with a consumer that continues to chug along?
Gasoline prices cratering. Absolutely cratering, offering some comfort, at least for now. Looking at CPI and PPI, maybe inflation's coming in. Maybe for now. That can change. If you bring up an intraday move of crude in the last 15 minutes or so, you'll notice a very small spike, and then we came back down again. Some reports from Reuters suggesting things could get worse.
A threat from this side, from the Iranian side. Reuters is saying that Iran has asked the Houthis to stand ready to close the Red Sea oil route if the U.S. goes ahead and wants to strike Iranian power infrastructure. So they say this has been discussed amongst the Iranian Islamic Republic's leadership, and the message has been conveyed to the Houthis. This, for the oil market, would be pretty massive, because that would mean that not only one chokehold, Strait of Hormuz, is shut, but potentially then you have some issues with the Red Sea, which you could see a lot of vessels have been moving product out of. Again, it's just a threat. It's just a threat, but you're going to get maybe a little bit of a premium.
Even if there aren't official negotiations taking place right here, right now, they are through Reuters and the Wall Street Journal.
Yes.
In the last 12 hours.
Ultimately, this is the way that we've seen it for a while now. And the reason why people are absolutely shutting this out, because it seems like continually they have found ways to de-escalate and bring things back from the brink, which is the reason why people are maybe uncomfortably numb, or maybe just comfortably numb.
This market's just itching to move on, and has been for, I forget how many months now. We're going back to March. Yeah. So, however many months that was. Coming up this hour, Julie Biel of Kayne Rudnick as stocks pull back on fresh AI concerns later. About 10 minutes away, the United Airlines CEO, Scott Kirby, as the airline boosts its profit outlook. And we'll catch up with Bank of America CEO Brian Moynihan after one of the bank's best quarters on record. What a quarter for the banks on Wall Street.
It has been unprecedented in many levels and exceeded expectations by tens of billions of dollars. And it comes in all sides firing, right? We've got capital markets, you've got the consumer. And the point that Tom Michaud just made, which is essentially because of less regulation or less regulatory constraints, they're winning share back from some of the alternative asset management units. And I wonder how much that'll continue being a theme.
We can spend some time on that. What did you call the airlines earlier? The AI trade?
A little bit.
Right.
I mean, at a certain point, everything's the AI trade, because we're all riding on the incredible investment boom that's gone into this sector.
Business and first class are the AI trade. I'm not sure about.
Hey, some of those guys could buy an airline based on how much they're getting paid.
I think that some of them did.
Right? Or a few jets at least.
Yeah, exactly.
My goodness, some of the salaries of those guys. Anyway, not jealous at all. We begin this hour with stocks inching lower as investors rotate away from tech. Julie Biel of Kayne Rudnick writing, I'm loving the solid earnings growth in small caps and seeing better breadth. But to be positioned to the lowest quality parts of the market in an already tricky market segment is perhaps ill-advised. Julie joins us now for more. Julie, welcome. So far, so good. Earnings have been fantastic. Expectations have been climbing. It's incredibly rare to see earnings this great outside of a recovery from a recession, but here we are. Where do you want to be? What do you want to avoid going into this earnings season?
I think you want to be really thoughtful about the positioning that you have in terms of companies that look durable for the longer term in case we do hit any air pockets with the AI trade versus companies that are utterly dependent on everything in AI working perfectly, which is what a lot of them are priced for right now, is absolutely no bumps in the road. And as we all know, development of technologies typically has a few bumps in the road. So I think it's really important to recognize that there are follow-through effects on the economy in terms of this AI spend. It's no longer just the fact that semiconductor companies are doing well. You know, there's important implications for what this means for construction spending, for the average electrician's salary. It does have some real wealth effects for people that I think are meaningful and that are supportive to economic growth. It's just that we're a little bit dependent on it at this point. That gives me a little pause.
What do you think the potential source of market risk is here? Earnings have been decent. That's been a comfort blanket for so many people. Is it the earnings? Is it the data? Is it a potential policy change?
You know, I think it's more a function of the own expectations that people have in the market are the thing that make the market the most vulnerable. So the places where you've seen expectations rise the fastest, and we've seen that with some of the tech companies that have reported what looked like really good results, and then the stocks underperform pretty materially because people are still hoping for ever more. And, that's the struggle with high expectations when you have these massive and very quick rallies, is that means that people are really holding their breath for the best news possible. And I think that's the vulnerability, is that when they get disappointed and their models aren't running as linearly in their growth or exponentially as it is for some of these companies, they really are disappointed and they pull back very quickly.
Julie, couldn't this be actually a point of confidence, not necessarily concern, given the fact that investors are being discerning? They aren't just buying everything. You're seeing shares come off even after they report earnings that beat market expectations, showing the skepticism is present.
Yes, absolutely. I think that's probably one of my favorite things about this, is how much many people really hate this rally is a great thing, I think, actually, because I think it keeps everyone pretty ready and willing to move in and out of things. And so it makes it harder for longer term investors, because for us, we really try to stay in the same place and own businesses for a long time. But I can really recognize that having these corrections, having people recognize that maybe the hyperscaler business is not going to be as profitable, the returns aren't going to be as robust, the competition is going to be much higher. I think that's a great thing, because when we lose that discernment, that's when we're really the most vulnerable. But I do think that the reflection of people pulling way back out of things, even though they report good results, it does tell you that there is a lack of real belief in the durability of it.
I'm wondering how you diversify away from the flywheel that just keeps on spinning right now, which is the wealth effect boosting the AI trade, the AI trade boosting the wealth effect, and just this cyclical virtual reality creating something that has benefited everyone. How do you hedge against the end of that flywheel?
Yeah, I think that's the concern that we absolutely have, is recognizing that, we're at a point where equity ownership is as high as it's ever been as a percent of people's total wealth. Before, that used to be housing. And it's very different when you can actually see the price of this asset that is your primary point of comfort and confidence in your own spending moving every day, intraday, pretty dramatically in some cases. So I think that does create some headwinds in terms of what that means for consumer spending if we do see any kind of drawdown or pullback, which would be typical for any kind of cycle. That's the concern that I think we have. I think the ways that you can be thoughtful about that is finding other markets, finding other places where there's less cyclicality and you're less dependent. I think healthcare is a really natural place for that. There are parts of healthcare that can be real beneficiaries of AI. And I think if you have an overall theme that AI is going to actually be more beneficiary for the users than it is necessarily the companies that are selling it, like airlines, for example, are, then you can really see a lot of benefits, particularly in small cap, of adopting this type of technology to be more competitive.
Julie, when it comes to the consumer, we continuously hear it's resilient, but you're a little bit more nervous about the lower end consumer than I think most. Why?
I still think that this is the consumer that's been the most hit by inflation. They're the most constrained. And I think that, you really have to recognize that for them, any increase in oil prices is pretty dramatic as a percent of their take-home pay. So while employment has been pretty good for them, it's been really difficult for them to find any real wage growth. They've seen that purchasing power really dissipate over time, more so than most people who are benefiting from the wealth effects of strength in the equity markets and continued persistence in home prices. So for them, I am still pretty concerned. It's not the largest chunk, but I think there's also, it creates a lot of friction for them and a lot of I'm getting left behind. And they know that now because everyone has Instagram.
Julie, thank you. Julie Biel there of Kayne Anderson Rudnick. That last point is important. People start to see how other people live. That's been a massive change.
Not everyone has Instagram.
I don't use Instagram, all right? I don't use Instagram.
Yeah, I know.
That kind of Instagram envy, I just think it's
funny.
really, really sad. I think it's really sad.
It is true, though. Everyone does see the wealth effects. There are benefits to
They
that,
don't
too,
see how the 1% live now. You see how the 0.00001% live now, and you think that should somehow be accessible. That is not healthy at all.
Touch grass. What was that? The Utah mayor who came out and said, everyone go out there and touch grass. And essentially, that's the argument you're making this morning. Jonathan Ferro is telling you to go outside and touch grass.
I'm not saying that, just like Instagram. Anyway, all right. Equity futures right now in the S&P down by 1/3 of 1%. Let's get you an update on news worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Oil spiking briefly. Reuters reporting Iran asked the Houthis to shut the Red Sea if the U.S. hits its power networks. The Wall Street Journal reporting that the president discussed seizing Clark Island in a meeting yesterday. JPMorgan CEO Jamie Dimon comparing Anthropic's Mythos to a ballistic missile. Dimon says the risks raised by the AI model are a real issue that the U.S. government is on top of now. JPMorgan has had access to Mythos since April and has been using it to test its own defences. In sports, the World Cup final is set. Argentina will play Spain Sunday after defeating England 2-1, coming from behind and scoring both goals after the 85th minute of play. President Donald Trump is planning to attend the game in New Jersey. And that is your Bloomberg Brief. John.
Let's talk about those Knicks. Jalen Brunson, something else, eh? Just phenomenal. Just fantastic.
Messi also.
Athlete of the year, without a doubt.
I did some digging.
Athlete
and
of the
Messi
year.
did win an award too.
Did he?
For his the Miami team he plays
That's
on.
good.
He won the best soccer player
Good
award.
to take note of that. All right. Up next, the morning calls plus the United Airlines CEO Scott Kirby as the airline boosts its outlook. Travel demand holding firm despite rising fuel costs. That conversation just around the corner.
At some point, the earnings growth starts to moderate. It's nothing disastrous, but it does start to moderate. I think you're seeing a little bit of unwind in sentiment, a little bit of unwind in leverage in these markets, but fundamentals continue to look quite good.
Earnings have been fantastic, better than good. Brian Levitt there of Invesco. The airlines printing money right now. Some of you might not be happy about that. We'll be talking about United Airlines raising their outlook, which is just amazing and unthinkable a few months ago. Bank of America, fantastic results earlier this week. That stock at a record high coming into this morning. We'll speak to Brian Moynihan in 15 minutes' time. Equity futures right now, the S&P 500 slightly softer, negative by 1/3 of 1% on the S&P 500. On the Nasdaq 100, we're down by 0.9. Bit weaker here. I've mentioned this a few times. Numbers there also good. What can you learn from how this market's responding to those results? Taiwan Semi, decent results. ASML, great results. Likewise with Samsung a few weeks back. And Bramo, this is the price action.
Yeah, right now, people are saying that the bar is really high. And even if you cross it, it's not good enough to really get people excited. Possibly it's actually a point of encouragement saying it can go further, given the fact that people aren't exactly walking around with beer goggle glasses going on.
You love that speech, don't you?
I do love that.
Yeah.
Jeremy Stein, fantastic speech.
I think it was Richard Fisher.
Whatever.
Right.
Richard Fisher of the Dallas Fed. Correct.
Yeah.
I got it wrong. Sorry.
I remember the same speech. Doesn't matter.
Details.
Okay. They kind of matter sometimes. Not them. Doesn't matter. Let's get to your morning calls. First up, Barclays raising its price target on Morgan Stanley to 262, citing its second quarter earnings beat. That stock is down by 0.7%. Morgan Stanley raising its price target on BNY to 151, highlighting clear organic growth momentum. That stock is up by 1/3 of 1%. And finally, Citi raising its price target on Goldman to 120, calling its latest earnings a, quote, standout quarter, led by trading. Earnings season ramping up with results from the major airlines. United boosting its full-year outlook, citing strong consumer demand, even in the face of higher fuel prices. The United Airlines CEO, Scott Kirby, saying, quote, United is built to thrive in every environment. Our brand loyal customers value their travel on United, whether they're in Polaris or in economy. The United Airlines CEO, Scott Kirby, joins the programme for more. Scott, welcome to the programme, sir. It's good to see you. Before we get into the results, I just want to take a step back, because if we were back in the middle of March and I was sitting here and you were telling me what you were about to do, I'd be like, Scott Kirby's gone nuts, because energy prices have gone sky high. People are going to stop flying. They just won't pay up. Scott, can you take us behind the scenes, how you and the company navigated that energy shock over the past few months?
Thanks for having me this morning. And really, it is pretty remarkable. You look kind of at the full year, what happened
fuel prices are up $6 billion compared to what we thought at the start of the year. And that compares to the best year in history where we made a little under $5 billion. And the fact that we're sitting here today raising guidance and talking about at least having a shot at growing earnings on a year-over-year basis is a remarkable testament to the strength of demand. And the demand and the economy are really strong, but also that United Airlines has had the brand loyal United Next strategy that we had is the right strategy. And the people of United are doing a better job than any airline anywhere in the world at implementing that, at taking care of customers. And we've been able to attract enough of those brand loyal customers to United that we've mostly been able to overcome the fuel price spike. So I'm really proud of the team for what they've done in a tough environment to make it feel just normal if you're flying on United or if you're working at United.
Scott, I remember earlier this year we were talking about how you expected demand destruction as prices got higher. You didn't see that, neither did other people, and you said you were surprised that you didn't see more demand destruction. Are you starting to see any signs of that, or at least customer fatigue in pricing?
No, we aren't. Demand is incredibly strong for us. In fact, our fourth quarter yields are booked 14 points higher at this point in time than they were at the same point in time for 3Q. Corporate demand so far in July is up 30%. We really haven't. And I think as you sort of take a step back from it and look at what's really happened, it's air travel share of the travel pie got really, really small coming out of COVID. And even with fares where they are today, air travel is the prices are 13% lower in real terms than they were pre-COVID, while hotels are up significantly, cruise lines and rental cars and everything else is up. And so I think we're just returning to a normal historic share of the travel pie for air travel. So the total cost of the trip is staying consistent with inflation. But after under-indexing to airlines, it's now over-indexing to airlines. And so the total cost of the trip isn't changing nearly as much as just airfares returning to the normal historical relationship that we've had to the total travel pie.
Oil prices have continued to inflect upward as a result of a new resurgence in the conflict in the Middle East. And I'm just wondering, is there more room to go with respect to responding to those extra oil price costs with higher fares going forward?
Well, like I said, airfares are down 13% in real terms from pre-COVID. So a short answer is yes. And in fact, there's been another fare increase this week. There were 5 or 6 when oil prices first spiked, and then when oil came down, they sort of paused, but there was another one this week. And so demand is strong, the consumer is strong, and it really is like our whole overall cost base. It's not just airfares, but our cost base with airport fees and maintenance and labor, those have actually gone up even more. And so it really is just a case of recovering all the inflationary cost increases that have happened, and recovering from the COVID trough in pricing.
We were joking, Scott, earlier that the airline industry also is an AI trade for a lot of different reasons, but in part because of the business travel and how much is picked up. How much do you see that being driven by all the capital markets activity that we keep talking about with the big banks, the idea that everyone needs to fly around, meet their clients as they prepare for these incredible fundraising exercises?
Well, I think it's probably more translated through in just what it means for the overall economy as opposed to, just specific the AI trade. But the economy is strong, and part of it is AI and all the build out that's happening with AI. But as I said, 30% up in business travel so far in July. Business demand is really strong. The U.S. economy is really strong, and we're a beneficiary of that.
One thing that we've seen is increasing creativity when it comes to how you approach different premium offerings. The latest being that in premium economy or economy plus, the middle seat gets blocked out and there's a shared table. I mean, is there something different about the creativity being used recently, whether it's different types of offerings, different segmentation, more specific offers to different slices of the consumer base?
We really are trying to build a great brand loyal airline nose to tail. We're investing heavily in premium, but we're investing just as heavily in the economy cabin. We recognize that today's basic economy customer is tomorrow's Polaris customer. And we're just trying to build a great airline for everyone. And, Starlink is an example. The Relax Row, which is in economy, is, I think, one of the coolest things we've done in a long time. An extra, a blocked middle seat in coach is just another example. And, at United, we really are trying to just try everything that we can to make the experience better for customers and believing that if we do that, we will have a brand loyal customer base that does really well when times are good, but it's also worth proving how resilient we are in times where something like, this oil price spike happens. I mean, the fact that we've got oil prices up $6 billion year over year, and we have a legitimate shot at growing earnings on a year over year basis is just a remarkable testament to what it means to invest for the customer and get customers to want to fly us, to decommoditize this industry. And really proud of the United team for what they've done to execute on that strategy.
Scott, more people in New York might be more willing to fly you when you get back to JFK. Is that still in the works for next year?
That is. We're very excited about it. Looking forward to getting back to JFK. Looking forward to, once we're back to JFK, we'll be the only airline with Starlink on the airplanes. For those of you that care about true high-speed Wi-Fi, we'll be the only ones in those markets. Looking forward to it.
Scott, I love the idea to relax row. When I was a teenager, young in my 20s, flying, when I saw an empty row of 3 seats and the plane taking off, I'd never been more excited. Yep. Yeah. And as soon as you got up to about 35,000 feet, I was on it, trying to lie down and move the armrest to make this work. Scott, have you had that idea for a long time?
I've wanted to do it. In fairness, Air New Zealand is the one that came up with it, and I've wanted to do it ever since they did it, and now we are. I'm excited about it. By the way, I spent a number of trips when I was young and non-revving doing the same thing. When we get to be our age, it's a lot harder to do that on those 3 seats, and so the relaxed row is going to be a lot better. And plus, you can hang out with your kids, and of all the stuff we've done, I personally think it is one of the coolest things we've done. It's going to be great for kids and families.
Very cool. Scott, it's good to see you. Appreciate your time. Thank you. Scott Kirby there, the United Airlines CEO, on a fantastic quarter for them, raising their outlook as well. Weren't you the same? You spot those 3 seats, that's mine. And you see someone outside get up, not a chance.
Yeah, that actually happened. that actually happened with my younger son on a trip over the past couple of weeks. But yes, of course. I mean, you start thinking about how creative you can be. You think about all of your childhood. I feel like it's sort of like a dream industry, considering how kids are with this and sort of how they plan and they set up their planes and they try to figure it out. And it's just like you grow up and you get to play also.
A takeaway from that interview, more fare increases are possible at United, and he's been surprised, and you were right to bring it up, surprised that there wasn't really any pushback from the consumer to these high fares.
And you heard the same thing from Delta, which is ultimately if oil prices stay high, they can respond to that with price increases, and they will respond to it with price increases. The question is, how do you divvy them up? Is it going to be focused on just the premium? Is it going to be passed through the entirety of the cabin? Is it all of the above? Ultimately, consumers have been shockingly resilient. That's why actually retail sales are going to be really interesting.
It's really impressive. United Airlines down a little bit this morning. Some decent numbers out of them in the last 24 hours. Up next, we'll get you a double dose of data, jobless claims and retail sales in just a moment. Plus, we'll catch up with the main man over at Bank of America, Brian Moynihan, on the bank's record quarter. That conversation just around the corner with equity futures right now in the S&P 500. Near session lows, we're down 0.4% on the S&P, down by 1 full percentage point on the Nasdaq. The data up next. Live from New York City, welcome back to the program. Equity futures on the S&P 500, negative here by 1/3% on the S&P, and the Nasdaq down by 1 full percentage point, 15 seconds away from economic data in America. The scores in the bond market shaping up as follows. 2s, 10s and 30s in the bond market. Yields higher by 3 basis points on 2s, up 3 on 10s, 458 on 10s, 416 on 2s. With your data, Mike McKee has more. Hey, Mike.
U.S. jobs. Good morning, John. Well, we've got some good news for spending today with the retail sales numbers up by 0.2% in the month of June. Americans still spending despite what was going on. Ex-autos, though, down 0.2%. But the control group that economists worry about, because that's what goes into GDP, up a solid 0.5% after a 0.7 rise the month before. So basically, Americans still spending, and it will help GDP. The Philadelphia Fed comes in at 41.4, up from 10.3, so a significant increase there. Prices paid index at 53.9 from 53.2, so no break from the decline in CPI, and the employment index for the Philly Fed at 10 versus 7.9, so some better news there. And finally, we have initial jobless claims And once again, it is confounding. 208,000, down from 216,000, a revised number from last week. So significant drops, still very, very low. Continuing claims, 1,805,000, down from 1,821,000. So all in all, the numbers are still very good for the overall U.S. economy.
Can't argue with that. Mike McKee, thank you. I guess 215 on claims, which these days is not much of a guess because it nearly always is. 215, 208.
Yeah.
That's
totally
the right kind of downside surprise.
You blew it. You thought it was 215.
Put it together,
He was
though.
wrong.
Seriously, soft CPI, soft
Yeah.
PPI, robust data, retail sales are good. That's a decent week of data for this market.
This is the exact kind of disinflationary productivity boom that everybody's been hoping for that can really be the cherry on top and highlights how comforting it is to see that equities are a little bit lower, at least from some people's perspective, just because people aren't taking this and running away with it. This is the euphoria that's been built into the market. Question is, how long can we stay in this good kind of backdrop that can really benefit a lot of different businesses?
The banks, the financials in prime position to leverage this moment. Bank of America, the stock, sitting at record highs after delivering blockbuster results. Equity trading revenue rising 70% in the second quarter. Fixed income trading climbing nearly 9%, making a record first half of the year for the sales and trading division. The Bank of America CEO, Brian Moynihan, saying against a healthy economic backdrop, resilient consumers and businesses are turning to Bank of America to spend, borrow and invest. Brian, I'm pleased to say, joins us now for more. Brian, good morning.
It's great to be here.
It's good to see you, sir. What a fantastic start to this year. Now, forgive me, we're journalists. We've got to ask, can this really continue at this rate?
Well, you just saw two statistics that I watched carefully, which is what the activity of the consumer is, and then ultimately what the unemployment new claims are. That's people argue it's leading or trailing, but it's actually an indicator of the health of the employment market, and a 4.2% unemployment rate with new claims at 1.8 on long-term claims and 208,000. Everybody looks at it and says, well, that's in line with 19. Remember that the workforce has actually grown a lot since 19 in terms of size. And so you argue about 7,000 on 160 million workers or something like that. So it's a pretty small number. And so nominally it's a low number, and percentage-wise it's a low number. And that's good news because that means the consumer spend. And what we see in our data is a consumer spending. If the consumer spend in America, that means the economy is okay, and that probably means the rest of the markets and the construct and the final demand is there.
The weather for the banking industry has been shining brightly. The sun is out. The backdrop's great. The environment has been good. I want to draw a distinction between the environment and execution because fees were up everywhere. What are you proud of after that quarter? On execution, where are you gaining market share?
Every single business grew the revenue, grew operating leverage, which is critical because that means your revenue is growing faster than expenses, and increased their returns. Every single business. It grew their customer bases and all those things. So what you're seeing us is the power that the engine of Bank of America is across all the businesses. So our consumer business made $3 billion after tax this quarter, plus. That's half as much as Wells Fargo made, and it's a big number. That's one of our four businesses that we disclose, in the smallest of which made $1.5 billion this quarter. So these are big businesses. They're scaled. They're accumulating new clients. They're accumulating new activity. The markets business had a great quarter, and the investment banking had a great year-over-year comparison. But at $2.1 billion for the quarter, we were $2 billion last quarter, 2.1. It looks like a huge increase because last year's second quarter, we all thought the world was coming in, and with Liberation Day, this year it's different. But what's really important is the pipeline they have is strong. The deals in discussion are strong, and you're seeing deals announced every day across all the spectrums, M&A, strategy, financing, all of which is important.
Just elaborate on that a little bit more. How strong is this pipeline? Because things just look phenomenal. We've had a record IPO. Alphabet came out with a monster equity capital raise. We saw SK Hynix more recently do something similar. We're going to see more of that in the year ahead.
Yeah, I think, so if you look at, we and all our peers are deploying more balance sheets. Our balance sheet to the markets business went up $100 billion for the quarter over what they thought they were going to be at, just to give you a sense. And so we have that capital base and that capability just to meet the moment. But if you look at investment banking, the deal, when you talk to CEOs, because if you think about last year this time and the amount of things they had to think about, we've added one with the wars, but at that time it was, taxes weren't set yet. The immigration policy was, people were trying to figure it out, trade and tariff policy, and then deregulation. You come to the fall, they felt that was sort of working its way through. Whether the tax and the tariff policy kind of looked at and said, it's sort of 10 to 15% of countries willing to do business with the United States, and 50 if they're not. I can figure that out. Let me go figure out how to run my business. That got, with a court decision, all the work that's gone around in circles a little bit. So we added some uncertainty. But on top of that, what you added is a year's worth of growth and a year's worth of belief that this year is going to grow at 2% plus. Next year is going to grow at 2% plus. That's convincing people that despite higher energy prices, despite inflation, despite the Fed having to keep rates higher, despite all that, the economy is growing through it. That's the interesting part. And I think CEOs last year got clarity on taxes, got clarity on deregulation, got clarity on immigration, and now are thinking hard about, wait, I can do things. I can see a little more distant in the future. Does that mean there's a parade of possibilities to change that? That's out there every day.
Let's talk about the parade of possibilities. Sorry, I'm a journalist, so I have to. There's this question about how market dependent some of this capital markets activity will be for the rest of this year. The idea that a lot of people are borrowing money they don't even need right now because the market is so wide open to them. What are the potential thresholds, whether it's in rates or whether it's a sell-off in equities, that could potentially stymie some of the pipeline?
So if we were here a year ago, you'd say nobody's ever going to get a mortgage at 6.5%, just to give you a sense. We were 30% up in production of mortgages this quarter. So as people get used to environments, they start to behave differently. And so the consumer borrowing is strong, but there's a lot of capacity left. But mortgage production being up 30% is kind of an interesting statistic in a world where if you said rates were going to be this high, they'd be doing mortgage volume. If you go to the commercial side, which is where you were talking about, we're seeing good loan growth, high single digits year over year in our core middle market, small business area. We're the largest small business lender in the United States. That's good news because that means, back to John's question, that's a little bit that if I'm not going to borrow if I don't need the money. I'm not going to borrow if I don't need to do something. Despite what people talk about, you're not going to issue debt and increase interest costs and have it just sit there because the arbitrage, if you don't issue below treasuries, which these guys, no borrower does, you're going to pay 300 or 400 basis points to let money sit there. It's just not going to work. So people are borrowing because they see opportunity, whether it's equipment buying, whether it's hiring, whether it's building a plant, whether it's inventory buildup. And so they're going to be more worried about can they get the margin on that. That's the question of inflation coming through the system later on. They're going to be more worried about will the final demand sit. That's watching the consumer behavior if they're in consumer side driven or if they're in supply chains, is the demand going to stay there? So I think the markets will stay there if the companies see opportunities, whether small, medium, or large size, and it'll stay there as long as they have something to do with the money. Nobody borrows money just to have it sit around.
Despite what people think about SK Hynix and what just happened. I mean, just saying, one could say.
They've got to have a view or they're going to do something, whether else they just ate in their profit margin. So whatever they're going to do with it, they're thinking about something.
One thing that you noted, the mortgages, is something that Tommy Michaud mentioned earlier. And he was saying that you've seen a lot of the traditional financial institutions gain market share back from alternative asset managers. And that's one of the reasons why the regulatory pullback has been so beneficial. Has that been your experience as well?
Well, I think also, the investor money going into the private capital funds and stuff has slowed, and there's been withdrawals and people getting out, and that then slows down the activity. But I think also the questions were raised around how much leverage is too much. And I think if you looked at the average leverage of the different deals, it was different inside the banking system and out. So I think we've seen a little bit of pushback to the system. And I think we also had to come with competitive responses. So we put together pools that we and our peers and announced two different pools where we could, when the opportunity was there, hit the bid for. The core difference is if we do a $5 billion transaction, we tend to syndicate it and get 5 banks in. That takes time and effort and creates a little bit of uncertainty. The other players are saying, I'll give you all $5 billion. I'll bring you the equity, plus I'll bring you all the debt. We build a practice where we can do more of that for our good middle market companies. It still will be laid off. It's just when you lay it off, up front or behind. And so we built a couple of things. I think between that and the efforts of the industry and the efforts of our company, you're seeing some of the market share come back in. So it's a lot of factors. But we grew commercial loans at 8%. And that's a pretty good growth rate.
Brian, you continuously mention if we were this time last year, Liberation Day, unsure about tax policy, where the deregulation was going, where immigration policy was going. Are you more focused on Washington now than you have been in the past because of how pronounced this administration has been on policy?
Well, I think the company's been around for 242 years. So we've been around through every administration that you can name, pretty much. So it affects the economy. When it affects the economy, it affects CEO's views of what they want to do. All that affects us. But I think so. An interesting question is right now is that there's the say-do paradox is as high as it's ever been. If you read the consumer surveys, it says I'm worried about, and listed out. Look what you just saw in retail sales in the month of June. The money moving out of the Bank of America customer accounts was 7%, high sixes. And in July, it was the same strength. That's stronger than it was in May and April and March. That is counterintuitive to what the people are. So people are upset about high gas prices, or upset about affordability. That's a fact. That's a fact that may change their behavior. Right now, the behavior hasn't changed. And I think that's sort of a parallel to all the things about policy. People talk about it and think about it, but if the underlying business conditions are fine, they just go to work and get through it. And so the question is, when does it affect their things? When supply chains become uncertain for pricing because of tariffs, they had to slow down and wait it out. Now they've got it kind of figured out, and they can pass it through. When the immigration policy meant they might not get workers, they had to think that through. They're used to that now, and a lot less immigration. They've rearranged their work supply. You still hear that from our small businesses, that workforce availability is a big issue for them, especially for the construction and things like that. And so I think we got to get that rational at some point. But right now, there's enough momentum behind it that we're going through it.
I've always given you credit to really understand where your research team is at with regards to their outlook, to know what they're thinking about with regards to rates. Other banks don't really do that. You do. Their view on interest rates right now, just share that with us. And if you can build on that, what does it mean for the business if they're right? That trajectory for interest rates turns out to be right later this year.
Well, number one, they're a great team, and that's why I listen to them, because they know a hell of a lot more about this than I do. Number two is it's a big investment, so you better take advantage of that investment on an annual basis. I have to say, this Friday they re-upped their things. They had 3 rate rises this year, and I think that was an outlier. And with some of these numbers, they may change that. But the principle they're saying is inflation will be here longer. It'll take us into 28 to squeeze it out. That's probably a year later than they thought 6 months, a year ago. But they've raised their, if you think about the travel over the last 12 months, 2.5% GDP growth of 26, down to 1.5, back up to 2.3. That's showing that they're believing that the AI build out, the consumer spending consistency, the employment consistency overweights this, and that's why rates will stay higher, because the economy is strong enough in inflation. And then you've got to wait through the second wave of inflation for gas prices. First, it comes to the fast turn stuff, and then it comes to slow turn stuff. And what I mean by that is this keyboard is produced with petroleum-related products to produce the plastic. It just takes time to get through the supply chain. So we'll see that. Their view is 3 rate rises this year. I can't speak for them, but I think the new numbers may change that a little bit. But we'll see. They're independent. They make their decisions. But the principle was inflation is going to be sticky, and we think it's a year stickier than it was a few months ago.
AI is a piece of that.
Yeah.
And maybe you can speak to what's happening internally at the bank right now. We've seen plenty of examples of certain companies, certain firms maybe backing away on spend, telling the staff internally not to do this, maybe to focus on that instead. How have you approached this moment, just on a cost basis?
We realized that was a risk from the start, so we built optimization models on top of the models, for lack of better terms. So, and then we also negotiated, for lack of better terms, sort of fixed-base pricing, so subscription model pricing. So, like with your firm, we pay you a subscription, and inside you have the Bloomberg, Ask Bloomberg, or whatever the AI capability. With other firms, we did the same thing, and so. Will that hold forever? I don't know. But for right now, we're not seeing a big cost increase. And so we expect to spend more on it, but it's more about implementation. And then if we look across, I think of 2 big differences in the accelerator. We've had Erica for almost a decade now, and we can talk about that and what we've learned from that. But if you think about the implementation since the ChatGPT moment type of thing, you've had one implementation where we're just spending money to get people really used to this, and that was to roll out across 200,000 people, the ability to have AI and use it and do things with it. Everything else we have had, and that's a very modest cost when you think about a $72 billion expense base, frankly, and with Microsoft and Copilot and all that stuff. We already had a big license fee. It increased it some, but that we said it would be hard to measure the incremental return. Everything else, 110 business cases, the 37 that are implemented, all have a business case that says, here's the cost, here's the benefits, revenue, expense, whatever it is, it makes sense. Let's make the investments. 37 are implemented. We implement about 1 a week. 110 are approved. It's just a matter of getting the work done. And they've had a profound impact on the company. Now, the reality is it's slower than people might think, and it has to be done much more carefully, because the $3 billion we spent on data over the last decade allows us to have these models operate in our company. Otherwise, it'd be a problem, because they'd be picking up wrong stuff, and it'd be a problem. So you had to have your data right, you had to have your infrastructure right, you had to have your security right, you had to isolate your data so it isn't taken into the world, so to speak. And so there's a lot of pre-work that the team got right. Now, that allows us to go faster once an idea comes up.
About a year ago, maybe a little bit more, you said that you thought that the effect on the overall employment picture for Bank of America was that you'd be able to do more with the same volume of staff. Is your view the same today?
We effectively just grew the earnings 30%, and we have a little less people we had last year. And so but meanwhile, in that is a very subtle exchange. So 18,000 programmers using AI coding. We didn't cut the programs, we just are doing more coding. We're just doing more activity. Relationship managers picking up agent force, and that's going through the system right now. We didn't change the number of relationship managers. We're adding relationship managers all the time. So, but if you had 100%, the 100 we in an example, 100 we have today could get 10% more efficient. They can do 10% more work. It doesn't mean we're not going to go to 105, because we want to have more production capacity. So it really is a very subtle answer depending on the activity. Our job is to handle it well and redeploy people. Last year we redeployed 14,000 people. We just hired 2,000 kids that will start next week from school. We hired 2,000 summer interns. We agreed to hire 10,000 military veterans. We are hiring a lot of people. We have to hire 1,300 people a month to have neutral headcount.
How concerned are you, and how much oxygen has been sucked out of the room from Mythos and some of the cybersecurity concerns from earlier this year? We heard some of your peers talking about that, and anecdotally, we hear a lot of fundamental concern about the risks to the financial system.
I think the administration looked at it quickly. The Secretary of Treasury and others said, wait a second. And so we all got started on this, and we've all been working a long time. And yet it just speeds up the pace of the work you have to do to patch the systems and do the things. So it's a serious concern. I think the so-called AI industry and industry writ large have worked together. But you can't think that we're ever going to be able to control this, because there's foreign models that people use. And not everybody's going to have the same thought process that our country has. But our country's tried to handle it and tried to be pretty systematic about it. But it's a big change in the amount of work that will have to go on and the pace at which these tools will affect your vulnerabilities in your system and how fast you have to take care of that. That's the core work that's going on. And then you've got proprietary software, open source supported software, third-party software, and we're making sure the third parties are doing the work and working cooperatively with the team. We have a great team there. We have 3,000 plus people that work in that area, $1 billion plus a year in spending, and they do a tremendous job under a fellow named Chris Fader, under Hari's leadership, and they do a tremendous job for us. And they work very cooperatively with their peers. And so you should rest assured we're all working hard on it. You should rest assured it's a serious issue.
I've been saving the most important question. You ready?
Yep.
How many World Cup games have you been to?
I've only gone to one, but I'm going to some this weekend.
I knew it. Too busy.
One game.
There's 102 of them.
You sponsored the World Cup. One game.
We share the fun. So we have teammates. It's been an unbelievable experience. And so we got my fan band on, and we've given out about 1.3 million of these so far this year. We've had 102 games. 102 games. Two left.
Which game did you watch?
I was in the quarterfinal in Boston.
Okay.
Yeah, and look, it has been something that has been very interesting for our company. But the way the team went after it, with the military tickets or the soccer fields, this is part of our Sports With Us complex, which the Golf With Us is the Masters and the Golf With Us program. Kids getting on munis for $5. The running.
I saw the Masters ad campaign. It was fantastic. By the way,
the running campaign that lets people run marathon. Yeah.
They went back to like legendary golf shots, and the kids replicated them. It was very cool.
And so now the campaign you're starting to see now is around the World Cup is sort of the you can do it. With David talking to the young lady named Callie, who's working with Street Kids United, which is a UK-based charity which runs a Street Kids World Cup that the commercials filmed that with David and Bono and U2, the new song, so it was kind of fun. But the idea is what we're trying to do is say fields in places. We're trying to soccer in schools. We're trying to help increase the availability of a game that is massively played in the United States, but just the availability on a access basis without having to spend for travel teams and stuff like that.
You've got to pick a team, Spain, Argentina.
I don't pick teams.
Of course not.
David's a good friend, and unfortunately that was a tough result yesterday.
Basically crying last night.
It was a tough result. So I never played the game. I have no merit to talk about the quality of any decision or anything that went on, the refereeing or anything. But I played football and rugby, and I have no idea how soccer's played.
But you could call Bex now and get his opinion.
He might have an opinion. I'll ask him.
Brian, thank you, sir. Appreciate it. You're a gent. Stock is at a record high. Fantastic numbers. Brian Moynihan there, the Bank of America CEO. Up next, we'll set you up for the day ahead. Plus, we'll get into this price action. Equities just a little bit softer on the S&P from New York City. You're watching Bloomberg TV.
What we see in our data is the consumers are spending. The consumers spend in America. That means the economy is okay, and that probably means the rest of the markets and the construct and the final demand is there. Despite higher energy prices, despite inflation, despite the Fed having to keep rates higher, despite all that, the economy is growing through it.
That was Brian Moynihan, the Bank of America CEO, on the program just moments ago. The backdrop is good. Sometimes it sounds really simple. You've just got to grow revenue faster than expenses. Operating leverage is positive. Things are okay. It's hard to execute. I think we've talked a lot about the environment. Backdrop's been great for these banks. A lot of these banks, including Bank of America, have executed tremendously well over the last quarter.
Yeah, and possibly even gaining share at a time when there is a lot to be had given all of the capital markets activity. The big question we've been asking is how much pipeline is there? How much of a forward look can you have? Everyone's come out today, this morning, over the past couple of weeks saying to the extent that we've got visibility, things are looking good.
Tons of Fed speak today. Look out for that. Look out for this as well after the closing bell. We'll get Netflix results too. The president addressing the nation as well later on this evening. That's noteworthy at 9 p.m. Eastern time. From New York City this morning, good morning. We'll see you tomorrow morning. This was Bloomberg Surveillance.